Fiscal policy is out of control. Monetary policy has actually been doing its job.
When we see the Fed raise interest rates, the economy tends to evolve in a very similar level.
I think a lack of a move higher in rates is enough to give some relief to equities.
I think for the bond market, it's really what happens in investment grade that's so critical.
Treasuries are going to trade much more in line with fundamentals over time. This might be the beginning of a secular bear market.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Let's get your working week started. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Your equity market this Monday morning on the S&P positive by 0.2%. The tension over the weekend, Tom, it felt like we were on the brink of a full ground invasion all weekend.
We're all doing it. We're looking at our phones, going tick by tick here. I'm using the live services of all the different news sites, and it just migrates forward, waiting for what? And you can see the politicians, I thought most interesting, jockeying here to keep their options open. You wonder I don't know what the options are for the people of Gaza. We'll have to see how that unfolds today.
We were all attempting to follow this war through the weekend. The IDF attacking targets around the northern part of Gaza, rockets fired at Tel Aviv and southern Israel as well. What we've been learning over the last 24 hours or so, Lisa, back-channel talks between the United States and Iran.
And there was a sort of feeling of frantic kind of diplomatic relations. The idea of Iran, who doesn't have any formal relation with the U.S., having back-channel talks, also having back-channel talks in some capacity with Israel, highlights how no one really wants this to percolate out of control, and yet the pressures just keep building and no one can come to any resolution at a time where there still are hostages, there still are strikes, there's still a lot of people dying.
There were pressures at the IMF meeting, and I thought the most salient thing is Managing Director Georgieva gave a lengthy statement on Israel and the Gaza Strip. John, she simply said, all we have to watch is the price of oil. Is that really where we are this morning?
That's been somewhat contained so far. Purely from an investor's perspective, Tom, will this conflict remain localized? Yeah. That seems to be the question on everyone's lips over the weekend and into a new trading week.
And I go north again. We talked about this. Lisa, I thought was great on it before we left. The triangulation here of not only Gaza Strip, but then over to the northeast to the West Bank, towards Jordan, and then up to Lebanon, and it was clearly a fractious Sunday in the north of Israel.
To your point about oil prices and how markets have been rather callous and sort of looking past it, a lot of the notes over the weekend were saying absolutely geopolitical risk and the potential for a broader conflagration is not being priced in anywhere in markets. But how does a market price in something where there are so many variables and where there's such frantic efforts to prevent the worst case scenario? Markets are just sort of tentative, and that's the kind of nervousness you can feel under the hood.
Brent crude right now, $90 and about 80 cents. WTI, 87.84. Let's whip through the price action on the S&P 500. Equity futures shaping up as follows. Positive here by 0.1% in the bond market. Another sizable move. I think we just have to get used to this now. A 10-year yield. Bramo moving 8 basis points higher. Your yield right now, 469.14.
I think that was exactly my conclusion this morning when I walked in and I saw, oh, look, it's bouncing the other way. This week, perhaps we'll get some sense of what all of the Fed officials think of it. Just to give you a sense, there, I think, are 14 speeches. I believe 7 individual Fed speakers capped by Fed Chair Jay Powell on Thursday at the New York Economic Club. We'll also hear from Philly Fed President Patrick Harker, New York Fed's John Williams, Richmond Fed President Tom Barkin, Chicago Fed President Austin Goolsbee, Atlanta Fed President Raphael Bostic, and Dallas Fed President Lori Logan before the quiet period next week. Earnings, Bank of America and Goldman Sachs on Tuesday, Morgan Stanley, Netflix, and Tesla on Wednesday. It's really all going to come down to the parlor game of who's winning, Goldman Sachs or Morgan Stanley. So far year to date, Morgan Stanley's lost less than Goldman Sachs, but both facing struggles. And on the economic data front, I actually think this might be really important. The sleeper data of U.S. retail sales, also housing starts, the beige book, which Tom reads from front to back, and jobless claims and existing home sales.
I think the retail sales is important to frame out, is it a recession or is it something above a recession? And the answer is, what I noticed, John, is the strategist toning up a better earnings season than expected. And I wonder how much of that comes from an American consumer, 70% of GDP, OMG, actually doing better.
You mentioned the IMF World Bank annual meetings in Marrakesh, Morocco. Let's talk about what wasn't discussed. Why weren't they talking about the bond market, deficits, what's been taking place in treasuries? I heard it like once with Gita Gopinath on your panel.
Yeah.
That was basically it.
Well, Joyce Chang saved the day as well from J.P. Morgan. They have a food court. You go down the beautiful awning and the wood things. They call it the food court. I call it the student union. It's no different than the student union when we were hungover juniors, trying to figure out if we had the energy for the 10 a.m. And you're in there, and there's nobody talking about the bond market. And yet everybody's glued to their phones looking at the bond market.
Doesn't really make sense, TK.
It doesn't make sense. It was the great, and this has happened at Davos, too. There's something always unspoken. Seriously, people were riveted by the tensions of the war in the Eastern Mediterranean, and you could feel that in the airspace of Morocco. But, John, I'm telling you right now, the bond market was the huge unspoken there.
Well, it's great to have you back, Tom. Welcome back, sir. Joining us now is George Goncalves, the head of US macro strategy at MUFG. George, let's talk about that bond market from a very specific angle. Does this budget deficit curtail America's ability to respond, support military escalation on multiple fronts?
Look, when you're already running wartime deficits before a major escalation or a bigger conflict in multiple fronts, it does make it more challenging. But it's not impossible. I mean, I think that their mobilization of resources would take place and prioritization would take place as well, and maybe cutbacks on domestic spending. But yeah, the real question is, can the bond market handle it, and what does it mean for the level of rates? I mean, the bonds get issued, but then it really comes down to the spillover effect and the crowding out of other credit markets. So the treasury market will always get funded, higher rates, no less, but it will take away money from somewhere else.
Well, there is this larger question, George, and I think that you raise it well, which is it's going to take money from somewhere else. Are you talking about that on an investment thesis or on a fiscal thesis, right? Because we're wondering, to John's point, whether this is going to curtail the ability of the U.S. to intervene with the geopolitics globally. From what you were saying, the answer is probably no. What does that disrupt in the market that people are not counting on?
I mean, look, we've had a pretty big, large increase of mostly T-bills and short-term funding to kind of get us back to where we needed to be post the debt ceiling back in early June. But now we really had to term out the debt. So as we're terming out the debt, I think that you're going to see a combination of more T-bills to a certain level, but I think that just more long-term debt, and therefore that's going to start to really hit the corporate sector and housing.
This morning we saw Rite Aid, or last night, file for Chapter 11 bankruptcy in part because of their debt overhang. Is this the beginning, just to sort of follow on to this point of you're going to see it in other areas, is this the beginning of a cascade of something larger within the corporate space as the fiscal space kind of deals with its own demons?
Look, I think it's going to really expose the have and have-nots and those that have access to liquidity and capital in the marketplace. And so, yeah, I mean, I think it is the beginning. I mean, we have to remember the average 10-year rate is somewhere around 3.2 on a 2-year look back. So over the last 2 years, we've gotten the 10-year back to about 3.2, which is where we were in 2011. So we really haven't made a lot of progress. And so if you think about if we're going to really see a Fed higher for longer, and let's say that rates are between 4.5 to 5.5, and corporate America is not ready for that.
George, frame out the real rate. That was, not on stage, but, in the corridors on the desert of Morocco when I was on my camel trips. That's what we were talking about. The 10-year real yield. Frame out your call on a 24-month 10-year real yield.
Look, I think that the real yield will stay higher and elevated, but it's also having this kind of pull effect on both the dollar as well as term premium. And there's multiple channels working here. You also have global rates in general rising as well, and that's taking away some of the capital they used to come back to the U.S. And even look at last week, the flight to quality bid into treasuries really fizzled really quickly. So the fact that that's all taking place at a time of all these large deficits means that real rates have to stay high, and probably 175 to 250 on the 10-year is probably fair game.
What does that do to the American economy?
Again, it's the cost of capital ultimately, right? And so if that is what exposes the companies that can't really make their interest servicing costs, I think that's what's going to get exposed in the next 18 months.
Is the Fed part of the game anymore, George? Just seems like they're taking a back seat over the last week.
Look, I think our view is that they're probably done. They're going to try to probably stretch the debate into early 2024 with the, hang the risk that they could also hike next year if inflation were to get out of control. But given that inflation kind of trends in a certain direction, especially core, I think that they're probably done, and they're going to have to shift their focus from all about hikes, but more about the neutral rate. What is neutral? And they're going to have to really make that case clear that they're not going to go back to zero rates. And I think they have to really hold their ground on that front.
Elisa went through the week ahead. Chairman Powell Thursday, Economic Club in New York with our good friend and colleague David Westin. We're all looking forward to that conversation. George, if you had a question for him right now, what would it be?
I guess, look, we've seen Chair Powell over the last couple of years pick and choose, certain indicators that he prefers. He went from jolts, and then of course he went, super core is really a Chair Powell fabrication. And so I'm wondering, does the super core still matter for him? It was high last week, as you guys know, at 0.6. Does that force them to kind of keep going?
A lot of people are wondering how fragile the market is as well, especially as we face a geopolitical risk. What a lot of people are saying is unlike anything we've seen in the past 50 years. George, how fragile is the market at a time where nobody can really price in how a conflict will escalate that seems to be right now sort of kept under control by frantic discussions and barely kept in control at that?
Look, I think this whole year has been a year of a market that's been on its toes and on edge. This uncertainty does not help at all. I mean, so we're heading into the time of the year where liquidity is less. It's been a choppy market. Even though risk markets have done well, they can give back those gains in a heartbeat. And I think that's what people are nervous about and looking to get insurance and get more defensive in case things get worse.
George, is there value in studying a 5-year duration to come into the near side of the belly of the curve?
That's a great point, Tom. I mean, I actually think that the sweet spot, especially if you look at what's going on with the tips and real rates, the sweet spot probably is the 5-year part of the curve. I do think that that's probably going to be where you can kind of have some comfort. Doesn't mean you won't suffer losses as rates rise or stay elevated, but I think over time you're going to make up for it. Especially if we're going to probably have a second impulse or third impulse of inflation 2 or 3 years down the ride.
The basic idea we're summing up on a Monday morning is higher for longer. I mean, everybody's writing about it. Everybody's thinking about it. What happens to the disinflationistas, people really looking for a drive lower in rates off of a disinflation vector?
Look, I think that's not completely in the back burner. I do think that we're probably going to see slowdown. I mean, because of the hikes themselves and the contraction of credit and the impact that it's going to have on corporate America and eventually jobs. So we're going to see some disinflationary pressures, but it's not going to be enough to bring us back to levels where it would warrant zero rate policy in QE. And therefore, it's hard to have a big rally in the bond market.
George, thank you, sir, for being with us. George Concalves there of MUFG. What a week we've got coming up. Chairman Powell on Thursday, retail sales a little bit later this week. Bear with me. As Lisa mentioned, we're about to go into the quiet period this weekend for the Federal Reserve's next decision in early November. Here's some of the Fed speak. Harker, Williams, Bowman, Barkin, Kashkari, Waller, Williams, Bowman, Barkin, Beigeberg, Harker, Cook. That gets you through Wednesday. That's not even
Can you
the
do
week.
it again? I was dancing.
I know, he's just
It's got a beat to it.
Absolutely.
Do it again.
Insane. How much is the Fed going to speak through this week? It's nuts.
You know where I stand on this. You're just busting my chops here. I think there's a crescendo of understanding that there's too much Fed speak. And that's all there is to it. I mean, everybody's got their favorites. I get it. I thought Mary Daly was, with you, Lisa, was just lights out. But come on. I mean, what I want to know is, are they comparing notes,
Okay, look, I think that everybody complains that they speak too much, and then they listen and they parse through everything that they say for some guidance in some sense that maybe they know something that we don't know and that maybe it can help guide things in a very uncertain moment. So, on one hand, you could say they speak too much. On the other hand, people are looking for guidance. The fact that they don't get it, maybe they're just frustrated that they're not getting some sort of oracle from people who don't have a better crystal ball than we do.
Goolsby, Barr, Bostic, Harker, Logan, Harker, Mester. That's the rest of the week, by the way. Throw in some Powell as well, if you need
Sounds
it.
like a Billy Joel song. Remember the Billy Joel song?
A lot of Harker. Harker's
to go back to what Mary Daly, the San Francisco Fed, said to Lisa a couple of weeks back, I think that conversation, Bramo, really set the tone for the broader conversation going into the November meeting, which is we'll allow the bond market to do the work for us, which is why a lot of people just assume November's off the table. If Chairman Powell wants to change that this Thursday, it's the last opportunity to going into the quiet period.
Since when has he ever ruffled feathers when he doesn't have to, right? Unless it's a mistake. I will just say also ECB officials have taken a similar tone. It seems to be the easiest pass.
Right. John,
yeah, go ahead.
I love it. You got to go to the moon.
Dancing.
Harry Truman, Doris Day, Red China, Johnny Ray, South Pacific, Walter Winchell, Joe DiMaggio, Joe McCarthy, etc.
Wait, what?
You have no idea what I feel so old right now.
Is this REM song?
Oh, guys, help me here. Email in.
Not American Pie, really? No,
what was that?
We didn't start the fire. William Joel.
Oh, William Joel.
Yeah, it's like when you were doing the central
I'm pleased you're rested. I'm pleased you're rested. From New York City, this is Bloomberg.
Would you support Israeli occupation of Gaza at this point?
I think it'd be a big mistake. Look, what happened in Gaza, in my view, is Hamas and the extreme elements of Hamas don't represent all the Palestinian people. And I think that it would be a mistake for Israel to occupy Gaza again.
The President of the United States speaking on CBS's 60 Minutes over the weekend. The latest reporting here at Bloomberg. Jen Jacobs, Justin Sink. The President of the United States considering a trip to Israel. According to two people familiar with the internal discussions, no decision about whether to travel to Israel has yet been made. But TK, based on our reporting, it's being considered.
I think everybody's stumbling around. I've been in a vacuum here the last number of days, and John, to parachute, you and Lisa have been watching it tick by tick. I have not. And to parachute in, the adjustment for me is just the options people are having against a blunt instrument of war. They're trying to verbal out the different options, the different choices they can make, and it's a huge muddle this morning.
Blinken's been everywhere, Tom. I think we call that shuttle diplomacy.
Yeah, I think
going
it's
from
shuttle
place to place between countries that don't necessarily speak to each other. And as for Iran, no formal diplomatic channels for the United States to speak to Iran, but the back channels that Jake Sullivan was talking about, the National Security Advisor, you get the feeling they're warning Iran off, Tom,
and I
from
think,
escalating this conflict.
Particularly media outlets that have an angle here are really looking at whatever their angle is on Iran as being some form of choice set. I don't think that's the choice set right now for America. They're focused on hostages. They're focused on the territory of the Gaza Strip, 2 times the size of Washington, D.C., and frankly, all that we witness, and this is important, everyone's playing to a domestic audience. I don't think enough is said about that.
Including the President. Yeah. If you are just joining us, welcome to the programme. Your S&P 500 this Monday morning shaping up as follows. Positive here by 0.14% on the S&P. Yields a whole lot higher by 7 basis points, 468.51 on a US 10-year. And in the FX market, Tom, 105.30 on the euro, slightly stronger against the weaker dollar.
We get expertise now, as we've done. Thanks to our team for really going internationally to get this done. Julie Norman is at the University College London UCL Center on U.S. politics, but also is weaned out of a PhD program and truly one of the world's experts on terrorism. Julie, what an honor to speak to you this morning. How is this terrorism? How is this, as the president mentions, narrow stridency of Hamas? How is it different this time?
Yeah, Tom, but this is a very different tactic than we see from Hamas, obviously, last weekend, and that's why the response that's being considered right now is also expected to be very different in scale, very different in tactic and operation. It also obviously has the end goal of, quote unquote, eliminating Hamas. That's I think going to be a difficult end game that's going to be tactically difficult over these upcoming days, weeks in Gaza. And just on a broader level, also, Hamas has a lot of regional dispersal, and they represent a certain type of resistance. And I think a lot of Israel's choices in these next few days have a lot of both moral and pragmatic implications in terms of, as we see civilian casualties rise and whatnot, that will in some ways galvanize much of what Hamas's goals have been. And I think there will be many who will step into their place. So it's a very difficult needle to thread right now. I think that's part of why we see Biden maybe considering a trip there into seeing how can Israel respond to this, but also try and avoid just a longer-term security risk.
And to play off one of your papers from a more peaceful time, beyond hunger strikes, the Palestinian prisoners movement and everyday resistance. Julie, you're as close to an expert on this as we're going to get. How do you perceive a military exercise from north to south in Gaza?
Yeah, so as has been noted many times, Gaza is an extremely difficult place to live, but also to carry out a military operation. We've obviously seen already the evacuation, the movement of upwards of 1 million people from the north to the south, but there's really nowhere for people to go at this point. And so even if the operations stay mostly in the north, we're still looking at a very difficult humanitarian situation really throughout the Strip, as well as just a likely devastation of infrastructure that I think makes an end game very difficult to foresee here. We heard Biden speaking yesterday about trying to preclude a possible reoccupation of Gaza. It's very difficult to see what governing or administration would look like in Gaza after this. Again, most of the civilians who are there are not going to have anywhere to go, and it's going to be very likely a very difficult situation for anyone stepping into that space.
It's been incredibly difficult to understand what's going on, Julie, not only because a lot of the conversations are going on behind back channel discussions, but also because of a vast slew of misinformation intentionally being put out from a number of different sides. I'm wondering, from your perspective, if you have a better sense of where the red lines are. We heard conflicting reports of Iran not wanting to get involved, then saying as soon as a ground operation starts, they're ready to go in. What have you gleaned over the weekend?
Yeah, well, you're absolutely right, Lisa. There's been a lot of misinformation, and I think all of us should be kind of careful and double checking many of the sources and whatnot. I would say in terms of Iran's movements, that I think will really be the deciding factor into if and when and how this conflict escalates. Iran has much closer ties with Hezbollah to the northern border of Israel than even to Hamas. And I think it's really the question of if they would activate Hezbollah, open up a northern front that would really change the contours of this war and make it a much more of a regional conflict. We are not at that point yet. Obviously, Secretary of State Blinken has been on a massive diplomacy run through the Arab world this week to try and deter Iran or Hezbollah or their proxies from further escalating this. But I think that's not a given. And that's one reason, again, why these conversations are going to keep continuing to see, okay, there's the operation on the ground, but also what can we be doing simultaneously to try and deter other actors, and especially Iran or Hezbollah, from getting involved even further.
It's a tragedy, and we all are seeing the tragedy unfold, a humanitarian tragedy on both Israeli families as well as in Gaza with people fleeing the north. I'm curious why, if we're hearing that there are 100 trucks backed up, ready to deliver humanitarian aid to Gazans that have gone south, why they're not being let through.
Yeah, so my understanding on this is that Israel wants to be able to check any of the trucks that are coming through for security reasons. So they will not give a guarantee that some of those trucks would not potentially be that they would not be immune from targeting and whatnot. So that's where the impasse seems to be. There is a lot of aid waiting on the other side of the border to come in. There are a lot of people in need waiting to come out. And I think where a lot of Blinken and Biden's conversations with Israel will be is trying to negotiate some kind of opening on that border to allow that passage.
Professor Norman, we're all falling back on our memories on this and our knowledge. If you look at the present day horror, and you look at Albert Harani's History of the Arabs People, or Fromkin's A Peace to End All Peace, are we now beyond the chain and linkage out of World War II of the Levant? Are we onto something new here?
I think we are, Tom, and this has been obviously coming for a while. This is a broader regional question. I think the Arab uprisings, the Arab Spring that we saw 10 years ago, many thought that would be a new direction. Those went a slightly different direction than many hoped or thought they would. But we are seeing now, I think, is a resetting. And again, a lot of this is in a context of, steps forward and steps back. I think there was a lot of hope this year around some normalization between Arab states and Israel, and many see this attack as trying to be a spoiler to that, which it obviously has been. So there's been again a lot of shifts in this region, and I think this war will be very definitive of where the region goes after this.
Judy Norman of UCL. Judy, thank you as always. New poll, CNN, last 24 hours. Ahead of Israel's expected ground invasion of Gaza, most respondents, this is Americans, said the Israeli government's military response to the Hamas attacks is fully justified, 50%, partially justified, 20%. A total of 21% said they weren't sure. 8% said it's not justified at all. I think this is really important, Tom, to put out there, because what you see over the last week, lots of controversial stories about what's happening on college campuses in this country, a lack of support for Israel.
Right.
You look at that poll from CNN over the weekend, TK, and I think that speaks emphatically to support from Americans for Israel to the events that have taken place over the last
Everybody
week.
reading that, including the administration. I know Anne-Marie Horton will be in touch with that.
AMH coming up in the next hour. Looking forward to catching up with Anne-Marie down in Washington. Coming up very shortly on this market, Liz Ann Saunders at Charles Schwab just around the corner from New York City. Futures positive by 0.16% from New York. This is Bloomberg. New trading week, your equity market looks like this on the S&P 500. Slightly positive through much of this morning, up by 0.16% after squeezing out a second week of gains on the S&P just last week. On the Nasdaq, pulling back, looking ahead to a big week for earnings just around the corner. Bank of America coming up later this week. Netflix as well. We get Tesla too. So Tom, looking ahead to earnings through the week.
Earnings started out good. I was watching you guys. Great coverage here. Thank you to Ken Leon for his wisdom, but I think it permeates across other sectors. And it'll just, I don't have a strong opinion on this other than earnings are already going to prop up the market here with a VIX of 19.09. We really haven't pulled back all that.
What's your takeaway from the JP Morgan results we got on Friday, Lisa? On the one hand, a lot of people ran with the headline, most dangerous time in the world for a long time. On the other hand, boosting the outlook. The outlook's better. Net interest income over at JP Morgan. Reserves coming in much lower than people thought they would.
They're making bank. They are minting money in an era of, yes, uncertainty, but also an era where suddenly people don't seem to be demanding to be paid interest on their customer deposits as much as the banks are earning from the interest that they can charge. And that's what you're seeing. How long that's going to last is the key question, and whether that's truly indicative of the broader corporate world, unclear.
They're the worries, they're the fears. How about 45 gazillion pre-COVID is turned into 65?
It's kind of what Bramo's saying.
Yeah,
we actually referenced you. We talked about you on Friday.
I heard on the back line, I had my earplug in Marrakesh. We were in this student union, and I heard you guys talking about it, giving me major FaceTime.
They're trying to hide how much money they're making.
I think everyone is. I think the dirty little secret, granted, there's some profit issues like fuel at airlines, but I think the whole earnings season is going to be like, well, it's business, but, it's all back.
Let's turn to the bond market. 2-year, 10-year, 30-year. 10-year last week, lower by more than 20 basis points. 30-year, same thing. Almost 20 basis points lower on a 10-year, more than on a 30-year. This morning, up 9 basis points on a 30-year, 484. On a 10-year, 468. So we had 5 weeks of 10-year yields climbing and then bang, lower. And lower off the back of CPI that came in a bit hotter. Lisa, PPI came in hotter as well, off the back of what we saw on payrolls the Friday before last Friday. Jobless claims still speaking to a hot labour market as well. It just appears the Fed has just backed away from this. Doesn't matter what the data looks like in the near term. That front end, unmoved by incoming information.
It is the only thing in the bond market that has any stability or any ballast whatsoever. Longer term, we don't understand inflation. We don't understand fully the Fed's longer term response. We don't understand geopolitics. We don't understand how much pressure some of these higher rates are going to actually impose on fiscal authorities in terms of borrowing discipline. I don't think that word is used in Washington, D.C.
Yields up this morning. We'll talk more about that story in D.C. and Marie up in the next hour. Let's finish on foreign exchange. The euro against the dollar. Euro-dollar 105.33. That currency pair positive by 0.2%. Under surveillance this morning, U.S. Secretary of State Antony Blinken returning to Israel after meeting with Arab leaders. The Israel Defense Force is saying 199 people have been taken hostage, and the army is now evacuating residents close to the Lebanon border ahead of a looming ground strike. Israel keeping open a safe corridor for people to evacuate the northern Gaza Strip. 600,000 people, Bramo. 600,000 have already left for the south.
And left to go where? And that has been one of the biggest concerns. They have nowhere to go. And so they're sort of left trying to find clean water, trying to find food as time is running out. This is a powder keg. And that is how I saw so many people refer to this, because it's not just in this region, but globally you are seeing so many tensions spring up around the world and in the Arab world. And Tom, you mentioned this earlier. There is a difference between the government officials and what stance they're taking and the groundswell of support that some of these factions have. And that, I think, is what's creating a really unstable situation.
I think there were lots of clearing of Gazas in other times and other places. A singular distinction here, and particularly to, worries about an Arab Spring and maybe the separation of societies in the Arab nations, is the video it's just shocking, John. The horrific Twitter videos I slipped by, they were in my feed and I went by. And I don't, this goes back to a guy named Marshall McLuhan, folks, and the fistfights around my parents' dining room table about the media. We're having that right now. And the whole media presentation here worldwide is front and center.
We're trying to keep up the speed, Tom, just witnessing really intense diplomacy over the last week or so. President Biden and German Chancellor Olaf Scholz weighing trips to Israel. Biden pushing to provide aid to both Ukraine and Israel. In an interview with 60 Minutes, the president saying this. This is a key quote. "We have the capacity to do this, and we have an obligation to. And if we don't, who does? Lisa, that's a question we're asking in the bond market. Do they have the capacity to deal with this?
Especially given the fact that there have been calls to cut borrowing costs and actually reluctance to fund the war in Ukraine. And now you add into this. That said, as you referenced, it was a CNN poll, a Washington Post poll came out with similar types of results. The overwhelming support in the United States is to support Israel and to continue to fund any kind of defense. You also saw 2 warships being placed in that vicinity to prevent Iran and more particularly Hezbollah from going into Israel. Where are the red lines? This is what I don't think we understand as they come and we see all of these frantic diplomacy talks.
Should we talk about a lighter story?
Please.
Let's finish on this. Shares of Manchester United falling in the pre-market by more than 10% after Qatari investors withdrew their bid for the team. British billionaire Jim Ratcliffe may end up with an initial stake of roughly 25% in the club, valuing the team at more than $6.1 billion. So the stock is lower, Tom, because ultimately what a lot of investors wanted to see was a full takeover by the Qataris at a very inflated price. And it looks like, based on what we're hearing over the weekend, that's not going to happen.
What's the history of success of a set of owners' clubs? I mean, the Yankees are a set of owners, but the Steinbrenners ran it. Newcastle, I perceive, is one owner. I don't know if that's true or not. That's the way I perceive it, at least, and that's been a big success. But can teams run with a set of owners in the English Premier League?
Let me put it this way. Has Liverpool had a lot of success under John Henry? I'd say they have. They've done pretty well, haven't they? Not distracted by what's happening.
They frankly should have beat the Tots, but that's a different
over at the Red Sox. Arsenal having some success as well. More recently, Stan Kroenke.
And they have multiple owners?
So Stan Kroenke's got multiple teams, hasn't he?
Yeah.
Looking across multiple things, if that's the direction we're going in.
What's it mean for Luton?
What's it mean for Luton? I've got no idea what it means for Luton, Tom. What it means for Premier League.
So what's the value of Man U right now, a wise one?
Based on that investment, north of $6 billion. North of 6. I'm not sure how much the Glazers wanted for this football team, but apparently the Qataris walking away, withdrawing the bid.
We'll continue to discuss this topic with surveillance English Premier League expert John Ferro. On the equity markets now, Liz Ann Saunders, Chief Investment Strategist at Charles Schwab. Liz Ann, from the peakish of early 2022, I've got SPX in a corrective state, down roughly 10%. I'll let you decide. Are we in a bear market or are we in a bull market?
You know, it's funny when you think about bear markets and lots of analysis of 1 year off the low and how that compares to past eras. But even the big, ugly bear markets like 2000 to 2002 and 07 to 09 had multiple cycles within them, to the extent you're using the simple definition of up 20% as a bull, down 20% as a bear. And I agree that there probably makes sense to have more nuanced definitions. But with that simplicity, you had multiple moves. So it's just too soon to say whether we're truly out of the woods. It doesn't look like a typical major market low, given fairly anemic performance by the S&P, no participation by the banks at all, minuscule participation by small caps. So there's a lot of check marks against the market, not to mention that only 2% of the S&P right now is trading at a 1 year high. So there's a lot of checks against the market at this point. That doesn't necessarily mean the market has to retest last year's lows.
Cut to the chase. I mean, you're way too young to remember Nifty 50 like I am, but do you go to the Saunders Nifty 10 or the Nifty 20, or do you actually index?
It's hard to outperform without the Magnificent Seven. They represent just about 30% of the index right now. That's relative to less than 20% in earnings weight. So I think earnings season is going to be key to see whether maybe we narrow that gap between the cap weight and the earnings weight. That said, having a small handful of stocks dominate performance in a cap-weighted index like the S&P or the NASDAQ is not uncommon. It's when you have the rest of the index so dramatically underperforming, whether you look at it on a percentage of stocks above certain moving averages or percentage of stocks that have beaten the overall index over some prior period of time. That's the problem right now. So what wouldn't bother me, even if we continue to see a bit of a sell-off driven by some of those larger cap names, is if we start to see some better participation. That was actually what was happening last October. You had a positive divergence because you had the indexes coming down courtesy of those big stocks putting downward pressure, but you started to see much more improved participation from a breadth standpoint down. So that would be the ideal situation, is a little bit of convergence. We're not seeing that at this point.
Lizanne, 2 weeks ago, we would have all been focused on earnings. We would have all been focused on what the tipping point was for equity valuations, given where bonds are and how much they've been swinging around. And now sort of this existential question is hanging over it all, especially after the weekend's events in the past week, which is how vulnerable is this equity market to an oil shock, to some other kind of shock? Usually it is going to be expressed in the price of crude. What's your sense? How much time have you been focused on that, given what we're watching, what we're seeing unfold in the Middle East?
Well, unfortunately, we're all at the mercy of the day-to-day news. So far, you haven't seen oil prices move up to take out the prior high. So I don't know whether that's near-term good news from an economic standpoint. I'm not sure that says much about where the conflict goes from here. Again, we're all at the mercy of the day-to-day news. But, it's hard not to think about the early 1970s and the 50 years back to 1973, and the fact that when you started to see the geopolitical pressure associated with the rise in oil, it was happening at a time where inflation was already bubbling up and the economy was weakening. There are times where you get a surge in oil prices for whatever reason, where if you've got much more strength in the economy and not a lot of inflation pressure, you don't see that feeder into the equity market to such a different degree. So I think, unfortunately, where we sit right now with general uncertainty with regard to inflation in the economy, if you were to add an oil price shock into the mix, needless to say, it would not be a good thing.
How much are you gaming that out? How much are you responding to client questions about that? Or are people just basically saying, we don't know what we don't know, we're going to keep going along with what we do know and just take things as they go?
It's interesting. I've been getting many more questions at client events that are about the deficit and debt and interest costs and fiscal situation and political dysfunction than we are about the conflict, possibly because they know our perspective on where the conflict goes from here is worse than most other geopolitical strategists, of which we're not one. So I think it's more of those domestic concerns, the rise in interest rates and what it means for our fiscal health that seems to be top of mind by our investors.
Lizanne, well said, as always. Lizanne Saunders there at Charles Schwab. Great piece over the weekend in Barron's on this, where we are now compared to where we were in the 70s. Crude production right now, you can bring it up on the Bloomberg terminal, 13.2 million barrels a day of production in this country. And like Liz, I'm in a similar position. That's all I've heard from a lot of people. The focus is not on energy security. The focus at the moment seems to be on the budget, the ability of this country to respond and support across multiple fronts, Tom, military escalation in the last 18 months.
At the IMF meetings, the most important person who wasn't visible was Tobias Adrian. He was locked in bilateral meetings, but he's head of fiscal sustainability. And the answer is that was what was percolating, except I would not say it was just U.S. deficit. Granted, it's a domestic issue. It's worldwide. These people have all these numbers tattooed to their brain.
But the dysfunction really adds this feeling of uncertainty. We may get some sort of vote this week on Jim Jordan, who basically is his bid to be Speaker of the House is dead in the water by all the reports that I was reading. There were some talks about Hakeem Jeffries on the Democratic side leading something with respect to bringing some bipartisan Speaker of the House. All I can say is the fact that we're discussing that and not some of these bigger issues that are suddenly driving the conversation in the investment world gives you a sense of where we are right now.
But it's some of the history here, and I take your point, and it's really my first question to Anne-Marie away from the Eastern Mediterranean. Is this percolating on a Monday morning of the middle ground gets together, maybe like what happened in the Polish elections? The middle ground gets together on Capitol Hill?
And supports a Democrat. That's a big ask, isn't it?
Yes. Historically, it's a huge yes.
It's not done.
This isn't Parliament.
It's not. Yeah. You'd prefer that, wouldn't you? I know you would.
It's wars of
I can't say that. You can say that.
That's what he's going to say.
I can't say that.
Order.
We're seeing tightening of financing conditions like it has never happened before. Our mission is to return inflation to 2% medium term, and we will. And it is happening as we speak.
What is troubling is the weak growth looking into the medium term. Second, Inflation has come down, but the job is not done yet.
The job is not done. ECB President Christine Lagarde, Geeta Gopinath of the IMF speaking in Marrakesh at their annual meeting with Tom Keene moderating in Marrakesh, Morocco. TK, great job on Friday and through last week.
Well, also fun, and it was huge audience, and it just massive anticipation, and there's always a surprise. So everything's set up. There's 47 people helping me make this happen. Trust me.
You took the entourage.
It's like, no. It's like the entourage of PhDs who know more than me. So you're in the back room, and they all come in, and they say exactly what they want to do, which has nothing to do with the panel, of course. So we get out there, and I open with Geeta to be polite. The managing director saying, the king of Morocco, blah, blah, blah. I go to Lagarde. I went to Ngozi of the WTO, the director general, got the typical Ngozi. I go to Lagarde, and it felt like an ECB press conference. I start in, I'm like, economic growth. And she goes, no, monetary policy. And it was like, I'm sitting there going, how much trouble is she going to get herself into?
You can tell us what you wanted to discuss. We mentioned this earlier in the hour, Tom.
Yeah.
Hardly talked about the bond market at the IMF annual meetings. I've got no idea why. When we were there in spring in Washington, that frustrated me as well. They seem to be having these conversations that are divorced from what is actually taking place in a world. And front and centre at the moment is some real bond market volatility in the Treasury market. Geeta Gopinath on your panel actually touched on it briefly, Tom.
Yeah.
We're finally starting to price some kind of fiscal premium, risk premium in places like Treasuries.
She brought it over to the World Economic Outlook, and you see the knock-on effects. When we say economics, finance, and investment, that's what we're talking about. To give us perspective on this right now, William Lee, chief economist at Milken Institute, serious tours of duty with IMF. Dr. Lee, thank you so much for joining this morning. Why does the bond market matter to people like you?
It really determines how it is that monetary policy affects the real economy. It's the bond market that's the key to the transmission channel of monetary policy. And I think one thing that we should be concerned about is that even though the IMF delegates were not concerned about the bond market, the Federal Reserve seems to be overly concerned about the bond market if they start talking about letting the bond market do monetary policy. The bond market's not the central bank of the United States.
Joyce Chang at JP Morgan made the distinction off of Barry Eichengreen's paper at Jackson Hole that this will have serious big country effect on EM. Do you agree that the future of, say, the Pacific Rim or broader Africa is affected by Jerome Powell?
You got it, Tom. When the dollar's strong, it starts to suck in capital from the rest of the world. And that's exactly, in some ways, the opposite direction that capital should be going, from capital scarce to capital rich countries. Now, granted, the United States is where productivity is highest. It's where innovation is greatest. And you can justify why it is that people want to invest in the United States. But to suck out even more capital from the emerging markets that need the capital, that's a problem.
But we need to dig into the bond market. When the Federal Reserve starts to allude to the idea they're willing to allow the bond market to do the work for them, it's a very specific part of the bond market. It's not the front end, it's not short rates, it's long rates. It's the 10-year and out. And that's where we're seeing all the volatility. Bill, can you talk to me about the effectiveness of that? Shifting the emphasis away from short-term rates to long rates in fixed income.
The usual transmission channel is that the short rates will influence the long rates, and it's really how it influences the long rate that allows the economists to try to forecast what monetary policy is going to do in terms of applying the necessary restraint. It's the long-term interest rates that are in the cost of capital. It's the long-term interest rates that affect the valuation of equities. So it's absolutely critical. But right now, what we're seeing is a rise in the term premium, and also, in some sense, a lack of credibility on the part of the Fed, and signaled by the fact that five-year inflation rates, very long-term inflation rates in the 10-year horizon, are starting to rise. And why is that? It's because people don't believe the Fed is going to take seriously its 2% target of inflation targeting.
So, Bill, do you find it odd that they're willing to outsource monetary policy to long rates without a firm, solid understanding of what's underpinning the move higher in long rates?
Well, it's a consequence of this I'll let the data determine what I'll be doing, and I don't know what I'll be doing until I see the data. This allowing the data to wag the monetary policy is absolutely the biggest mistake you can have. The Fed has always been objective driven. It always had policy targeting, whether it's intermediate targeting like money or interest rates, or final targeting like inflation or unemployment, or both. But right now, to say that, gee, I am going to let the data determine what I'm going to do, and I won't know what I'm going to do until I see the data, that's nuts. And that means we have unanchored bond markets. And when the bond market's unanchored, it's going to be doing whatever it feels like. It's going to go up one week, it's go down another week. In fact, it can do it all within 1 week.
And that's what we have been seeing over the past few weeks, Bill. I am curious, though, given your study of the flow of money internationally, of some of the whys behind the volatility in the bond market, the rise in the long end of the yield curve. We were speaking with Dalip Singh of PGIM Fixed Income, and he was saying this is due to a lack of price-insensitive buyers in China, in Japan, from Asia. Do you buy into that? Do you think that that is underpinning why you have had an unanchored longer-term bond yield?
A lot of the capital flows are, in some sense, price insensitive because they're very strategic right now. China's at the heart of all this. I just got back from a month in Asia, South Korea, Singapore, and Taiwan. And I got to tell you, everyone I talk to has got China on their mind and trying to develop a strategy as to where I should park my money if I'm going to be taking it outside of China. And right now, in fact, people are being strategic and saying, let me start to use the political tensions that the U.S. and China are having by saying, let's add more U.S. content. Mexico has become a haven for a lot of strategic capital. To plug one of our Milken Institute reports that just came out, Mexico as a strategic partner is a report that my colleague Maggie Switek just put out, and it's worth reading because it tells you imports from Mexico have now exceeded the level of imports from China. That's how important finding alternatives is right now, and that's determining a lot of the capital flows.
But you're talking about going into places that might benefit from China being de-emphasized as a trade partner. What about China itself as a buyer of U.S. treasuries? What about some of these other investors as potentially seeing U.S. government debt as an option?
China's not much in a position to do much as a source of growth for the world. It's not doing much except the fact that it has continual surpluses for the United States in terms of buying up our treasuries. In fact, China is going out of its way to try to diversify its reserves and go to euros and something else, even cryptocurrencies, in order to reduce the dominance of the dollar in the international monetary system. So it's not going to be behind the buying of treasuries going forward.
Hey, Bill, wonderful to get your perspective. It always is. Bill Lee there of the Milken Institute on the latest on the deficit, the bond market, Fed policy, and China. This is the latest from Stuart Kaiser over at Citi. Tactically positive on the equity market. Macro data, the FOMC third quarter earnings are supportive. The flows picture is solid. Looking for an ETF, Tom, that tracks the NASDAQ 100, the Qs.
Yeah.
That's where he's bullish right now.
I'm going to call this an outlier. I'll let other people smarter than me say so, but I read every word of the Kaiser report, flat out bullish, flat out pushing against the gloom that's out there, but again, selective, and that's what we were talking to Liz Ann Saunders about. I don't think you buy the ETF on the Dow Jones Industrial Average. I just don't think that's a wise move.
Apparently you do it on
right
the NASDAQ
now.
100, according to Stuart Kaiser. Let's go through it piece by piece. Payroll solid, jobless claims still low. Banks like JP Morgan boosting their outlook going into year end. And at the same time, the Federal Reserve, Lisa, unwilling to step in and spoil the party. That's the sentiment story. Now give me the guidance, the outlook beyond fourth quarter. This was Julian Emmanuel's problem over at Evercore. I was talking to him about it on Friday. Like JP Morgan, the outlook into year end, it's okay. And then beyond there, it's like the unknown.
Which is the reason why Stuart Kaiser and others are saying, well, we can't see it, you can't see it, so just look what you got right now. And what you got right now actually is looking pretty good because so many people got caught up with becoming a recessionista, yours truly, that you started to, get away from the actual data on the ground, which was telling you something very different. And so now people are just looking 2 feet in front of them rather than trying to look more than 10.
I think there's people looking at 3 or 4 years, and they're looking at this pullback, like Stuart Kaiser, and they're using traditional security analysis to say, okay, I have to participate. How? The complete mindset now, John, is should I be in cash or not? And the answer is people like Gina Martin Adams or Stuart Kaiser saying, I have to participate. What's the intelligent way to do it?
Should I be in cash or what? What else should you be in? What's the alternative when you could pick up 5%
It's a general state. Well,
into the absolute
institutionally
unknown?
a 60-40 portfolio, but the way the bond market's moving around now, I'm not sure what the 40 is.
Let's talk about that bond market move right now. Yields are higher, again, on a 10-year by 8 basis points. Let's call it 469 on a 30-year. Right the way out to the back end of the curve, the 30-year up by almost 10 basis points again. 485 on a 30-year yield in America. The bond market is just absolutely crazy in terms of the intraday moves at the moment.
Wild.
In the FX market, the euro a little stronger, dollar weaker, 105.32. Equities firmer by 0.25% on the S&P. In the next hour, we'll head to Israel and catch up with Bloomberg's Ollie Crook alongside Bloomberg's Anne-Marie down in Washington, D.C. Together with Jay Pawlowski of TPW Advisory. Jay Pawlowski, constructive on the outlook for this market. That conversation in the next hour. Live from New York City this morning with equities pushing just a little bit higher. Good morning.
Fiscal policy is out of control. Monetary policy has actually been doing its job.
When we see the Fed raise interest rates, the economy tends to evolve in a very similar level.
I think a lack of a move higher in rates is enough to give some relief to equities.
I think for the bond market, it's really what happens in investment grade that's so critical.
Treasuries are going to trade much more in line with fundamentals over time. This might be the beginning of a secular bear market.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Live from New York City this morning. Good morning. Good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Your equity market positive here by 0.3% on the S&P. 2 weeks of gains. Can we make it 3? TK, what a tense weekend. It just felt like we were on the brink of escalation through Saturday, through Sunday, into Monday morning.
Our world of economics, finance, investment pushed aside by the geopolitics. In this hour, I believe we're going to Anne-Marie Horton and Oliver Crooks is in Tel Aviv with a fractious weekend.
Bramo, on the brink of escalation and seemingly on the brink of a full ground invasion over the past week.
And Tony Blinken popping around the entire region, trying to have back channel, front channel, every channel conversations with everyone in the region to gauge out where they stand, how to prevent some sort of escalation. One thing that I felt over the weekend, I couldn't tear myself away from it, as everybody I'm sure feels the same. The lack of clarity was just shocking to me. As time went on, there was just this fog of uncertainty and misinformation put over everything. And I just started to feel like, we will only know it in retrospect.
Well, let's build on that. I think it's really important. The lack of clarity around one specific issue, hostages.
Yes.
This is a really, really important topic,
yes.
Lisa. It felt like over the whole weekend we were on this brink of this full ground invasion by Israel into Gaza. It didn't happen. There was a sense based on several reports, and there's some conflicting reporting around this story,
yes,
whether it was the hostage situation that was slowing things down.
There was some discussion about Qatar and possibly Egypt helping to negotiate some sort of hostage release, that Hamas was asking for a number of Palestinian prisoners in Israel to be released in counterbalance. There also was a discussion about trying to avoid killing the hostages as they went into Gaza City. All of this is just in the sort of fog of back-channel discussions as everyone works frantically to try to avoid a larger conflagration. I can't express how emotional and tense this is for everybody in the region.
Well, I think the emotion's there, but to John's point, I think this is really important. It's horse before cart. And to me, the hostage discussion right now is the horse. And I could be off the mark on that, but I just think it's front and center within all the different parties and the narratives going on right now.
So Secretary Blinken is back in Israel. There are conversations based on our reporting about the president, together with Chancellor Scholz of Germany, making a visit to Israel at some point. These back-channel talks, Bramo, let's just breathe some life into that conversation. There are no formal diplomatic arrangements for the Iranians to speak with the United States. They have these back channels, so to speak. Jake Sullivan, the National Security Advisor, suggesting they used them. In fact, told us they used them over the weekend, essentially to warn off Iran from escalating this conflict.
I mean, 2 aircraft carriers in the region also sends a pretty strong message from the United States. But yes, there was this feeling of, look, we see you, we get you, we're not going to accuse you formally of having orchestrated these attacks, but please do not encourage Hezbollah right to the north of Israel to get involved. And you have seen a tit-for-tat kind of escalation, but not to the degree of some sort of more full kind of ground incursion on the northern border. But that is really what people are trying to prevent.
Don't is a word we've heard repeatedly from this president in this country. Don't. Your equity market on the S&P 500 looks like this, positive by 0.25% on the S&P, yields higher by 8 basis points on a 10-year, 4.69 on a 30-year yield. The volatility in this bond market, intraday price action, unreal. 30-year yield this morning, Lisa, up 10 basis points, 4.85.
And whether this is doing the work for the Fed or not, we'll hear all about it. We've got a lot of Fed speak this week. I mean, the list is very extensive. It really is capped off with Fed Chair Jay Powell on Thursday, with our own David Weston at the New York Economic Club. We'll also hear from Philly Fed President Patrick Harker, New York Fed's John Williams, Richmond Fed President Tom Barkin, Chicago Fed President Austin Goolsbee, Minneapolis Fed President Neil Kashkari, Atlanta Fed President Raphael Bostic, Dallas Fed President Lori Logan. I feel like I am listing people at some sort of religious event, and we will hear from them. Earnings, meanwhile, Bank of America and Goldman Sachs on Tuesday, Morgan Stanley, Netflix, and Tesla on Wednesday. A lot of people focusing on the horse race between Goldman Sachs and Morgan Stanley. Others really on the tech earnings. Just how much are the Qs going to continue to outperform? And economic data, really retail sales. How much does the consumer still have to spend, especially at a time where the Fed's Beige Book on Wednesday, which, Tom, you read every week?
On it, cover to cover. Can't wait.
I mean, it may suggest some weakening, and then we'll get jobless claims that will not suggest any weakening.
Look, the anecdotes we've had from Fed speakers, regional Fed presidents suggesting there is a slowdown, that they're hearing from people in their districts, Tom, that are telling them there is a slowdown in this economy. The problem that we have at the moment is payrolls knocked it out of the park. Jobless claims are still incredibly low. And we'll see what we get from retail sales tomorrow, Tom, a little bit later this week.
Maybe lagging indicators and all that. I'll let our guests explain that to us. But it's the same story as it was 6-8 months ago. Except 6-8 months ago, we were certain there was a recession, and now there's just silence on it. I mean, there's no other way to put it. Why don't you bring in Handsome Jay Pulaski?
Is that what we're calling Jay?
Handsome Jay Pulaski.
Handsome Jay. Jay Pulaski will love that, Tom. He joins us now, principal and founder of TPW Advisory. Jay, keep it together. We'll have a serious conversation now. Jamie Dimon at JP Morgan says this may be the most dangerous time the world has seen in decades. If you park the rhetoric and focus on the numbers, this is what we got. A record quarter of net interest income, boosted the forecast for the year, reserve for loan losses coming in better than expected. Jay, do I follow the rhetoric or the numbers out of these banks on Wall Street?
Yeah, John, it's great to be with you guys, and thanks, Tom, for that compliment. I don't even get that at home, let alone anywhere else, so thank you. John, it's interesting you picked that example because that was one of my examples that I wanted to use because I think it just shows the gap between kind of superficial first-level analysis and something deeper. The superficial first level is taking Jamie Dimon, one of the most respected bankers in the country, if not the most respected right now, at his word when he says things are as bad and as scary as they have been in decades. And then the second level of analysis is the actual returns of the bank, which were stellar. And I focused on one of the points you touched on, which is the release of reserves, right? So if things were bad, banks build up reserves when they're making money. Banks printed a ton of money. Between the three, JP Morgan, Citi, and Wells Fargo, net profit was up 34% year on year, 34%. So that's a perfect environment to increase reserves in case you're worried about this horrible environment. What did JP Morgan actually do? They actually released reserves because they over-reserved 6 months ago. Tom was talking about 6 months ago. 6 months ago, 7 months ago was SVB and big time bank concerns. That is not the case anymore. So I just think there's a tremendous gap between kind of all that's going on, which you led to in the prelude between the three of you chatting, and the actual reality underneath. So you can be very scared and very worried if you just read the headlines, but if you look beneath the surface, things are actually, I would argue, pretty good and getting better, most importantly.
Jay, the single paragraph in your note that you are simply out of the bond market is confirmed by the Bloomberg Total Return Index. It is on the precipice of making new lows. On a price basis, we're back to a 2016 bond market. What happens to the stock market if we get priced down higher yields on that aggregate index?
Yeah, no, that's really the big tension right now, Tom, right, between assets is, the old 60-40 worked like a charm over the 2010 to 2020 period because rates were coming in, right, massive bull market for a decade, and now we're having the reverse. And we wrote about the coming bond bear market several years ago. We've been out of treasuries for the last 2 years in our global multi-asset model portfolio, completely 100% out of treasuries, even though our benchmark is 40% fixed income. We have been in credit We continue to be in high yield in the United States, for example, continue to be in emerging market debt, both local currency and corporate. But to me, the issue is the market priced in, particularly the bond market, priced out, the recession call, right? The bond market was a big believer in recession, way more than the equity market. And when that story got knocked out by Jay Powell a month or so ago, when the Fed doubled their growth estimates for this year, significantly raised growth estimates for next year, took out 2 rate cuts for 2024, the bond market had to reprice at speed, and it has done so. And as long as nothing breaks during that repricing, then we're okay. And I would argue that we're much closer to the end of that repricing than we are to the beginning. Real rates are high. 10-year real yields are about 2.5%. Historically, that's quite high. Inflation is coming down significantly, and we think will continue to do so. So I'm, as I mentioned, I think last time on the show, contemplating bonds is an interesting opportunity. They rallied very aggressively, and that took away the opportunity. But between 450 and 475 on the 10-year kind of makes sense to me in the environment that I think we're going into, which is continued solid, decent economic growth in the United States into 2024 and beyond.
Well, Jay, just quickly here, then is it time to transfer out of corporate debt, especially as we just heard from George Concalves, the tip of the iceberg with Rite Aid and defaults and bankruptcies, and go back into treasuries?
That's I don't think so personally at this moment. I don't buy the default story in the high yield market. That's not really being supported by broad data. Yes, you can cherry pick individual names, but the reality is that defaults are quite low, and there's no real indication that they're going to pick up dramatically, particularly if the economy is going to be okay. And the big issue for high yield is the refinancing issue, the refi mountain as it's called, and that in high yield in the U.S. doesn't come for 2 or 3 years. So we think there's pretty much still opportunity. In our view, where we want to be, we think the global economy is picking up speed. We're in the early stages of a manufacturing recovery around the world. Earnings next year in the U.S. Forecast to be up 12%. Equity market should be fine in that environment. We want to be in commodities for that strong growth opportunity. We like emerging markets. We like China, as we talked about on this show before. And so that's where we see more opportunity than, switching into U.S. Treasuries. I don't think there's a lot of downside from here, but I also don't think there's a lot of upside, and there's better opportunities, upside, risk-reward basis elsewhere than U.S. Treasuries.
Maturity mountain. I'm going to use that, Jay. Handsome Jay Poloski at TPW Advisory. Is that going to catch on, TK?
It is. It's a substantial. It's a substantial idea.
Nice. If you're just joining us, welcome to the program. The S&P positive here by 0.2%. Yields a whole lot higher by 9 basis points. Look at that, Lisa. 470, back at 470 on a 10-year. Go further out on the curve. 30-year, up by 10 basis points. Let's call it 486 this morning.
And so we could close either at 480 or we could close potentially at 450. We don't know, because that's basically been the ride that we've been on. And the why behind it has been so unclear. It has gone down, yields gone down in light of better than expected economic data, and it's gone up in response to worse than expected economic data. Go figure.
Guys like Jay Poloski are hardwired to this. We look at price, and when we shift from a yield analysis or spread analysis, and it's like, oops, price, you look for benchmarks. The Vanguard Total Bond Fund, and this doesn't include the income. This is just on a price basis. It's paying income along the way, so-called carry, John. It's down 21% from June of 2020. Along that 3-year-ish period, it is down 7.3% per year. Operative word for us and fancy people in Marrakesh, never. Never seen it.
This bond market has hurt this financial sector. On the banks a little bit later, Eric Najarian of UBS. In the next hour on the market, Peter Cheer of Economy Securities. Next on this program, on the ground in Israel, Bloomberg's Ollie Krug on the latest following a weekend full of diplomacy. And we'll catch up with our chief Washington correspondent, Anne-Marie Hordern, live in DC next.
we need Congress to act. And the president has made clear that he is going to go to Congress with a package of funding for Ukraine as well as continued support for Israel. You can expect intensive engagement with Congress this very week as we work on such a package and seek to secure bipartisan support for it.
That was Jake Sullivan, the U.S. National Security Advisor on CBS, speaking of intensive engagement with Congress this very week. We've had an intensive weekend of diplomacy. Secretary Blinken back in Israel after spending the weekend at one point in Riyadh with the Crown Prince Mohammed bin Salman. The big takeaway from that conversation with Jake Sullivan, the National Security Advisor, this quote right here: "We have means of communicating privately with Iran, and we've availed ourselves of those means over the past few days to make clear privately that which we have said publicly." And as we know, Tom, what they have said publicly over the last week is don't, and warning off Iran of any escalatory moves.
Yeah, I hear different narratives here. And you mentioned this, John. I believe we weren't on air, and I think it's very, very valid. There's got to be all sorts of other stories, many covert, going on. I don't think we're fully informed, and I wonder, are people like Mr. Sullivan fully informed on what's really going on the ground? That's what's called a war.
Well, officials are trying to discern a lot of details, including how many hostages, you mentioned that, were actually still being kept in Gaza. Now the number is something like 199, according to the latest reports. How this is featuring into discussions with Iran, especially since a lot of those people are nationals of other countries as well.
If you are just joining us, welcome. I want to get you up to speed on what's happening elsewhere as well. On the equity market, on the S&P, positive here by 0.25%. Equities drifting a little bit higher, really divorced from what we're talking about at the moment with regards to what's taking place in the Middle East. Yields a little bit higher here, Tom, up 9 basis points. The 10-year, 470.
Right now, we're going to continue our coverage. Anne-Marie Horton is in Washington, our chief Washington correspondent, and Oliver Crook is in Tel Aviv this morning. Oliver, just simply translate us away from 9 news sources, all the TV, the blur of the news. What did you observe in Tel Aviv this weekend?
Well, it's very, very quiet here, Tom, and amid the war that is going on in the south and some of the skirmishes that are going on in the north, in Tel Aviv, there's a sort of very eerie calm. We, on our bureau, and where we're positioned right now, is on the Rothschild Boulevard. This is a very active part of town. I was here just 7 months ago. There are tons of people out in the streets generally. It is completely quiet. Life has come back a little bit today, but most of the businesses are closed, and there's a great despondency here in the streets. And, of course, people in Tel Aviv are not accustomed in recent years to go to bomb shelters, as we have done several times over this weekend, about 2 times a day since Friday.
Ollie, there is this uncomfortable quiet that you speak to. Let's build on that. All weekend, it's felt like we're on the brink of a full ground invasion. From the reporting that you've done, Ollie, from the people that you've spoken to, what's preventing that from happening anytime soon?
Well, the question, John, is, again, what kind of invasion are we talking about? Because is it just everybody rolling in? Is it tactical operations? We understand that there were some tactical operations in Gaza as early as Friday. But what we understand now is, as we know, hundreds of thousands of troops that are amassed on the border. The thing that the Israel Defense Forces did confirm this weekend is that the next step will have a ground component. Air, sea, and ground, they said. The question is of when. And now with all of these leaders now coming, potentially Schultz tomorrow, and if Biden comes, potentially, is that held off for another period of time? I think it is very hard to say. Again, on Friday, the message from the Israelis was, we have not decided yet officially to move in. But again, that has evolved over the weekend.
And Marie, as Ollie indicated, we've had a weekend full of diplomacy. Secretary Blinken in Riyadh, back in Israel. Talk to me, Anne-Marie, talk to us and explain to us what's come out of that weekend full of intense diplomacy.
Well, the first thing is that Secretary Blinken, after he left Cairo, there seemed to be this understanding that they would open up that Rafah border crossing. That'll be incredibly important for these American Palestinians that are trying to get out, Palestinians that are trying to get out of harm's way, as the Israelis have told them to move away from Gaza City and towards the Egyptian border, and also humanitarian aid that the UN says is waiting on convoys on the Egyptian side to come in. The issue is, although it does seem like there's a diplomatic push for this, that Rafah border crossing has yet to be opened. So that's something key that came out of that discussion from Secretary Blinken over the weekend. And now he's back in Israel on the same day that we do have reports that Benjamin Netanyahu, over a phone call over the weekend, invited President Biden to actually come to Israel to show his support, and Blinken decided to stay in the region. So I would say there is this potentially, of the President of the United States going to Israel. First and foremost, this would be a huge show of support to the Israeli people. It would also deter this conflict potentially from expanding. It would be a huge deterrence to, say, Iran or Lebanese Hezbollah if the president of the United States shows up in Tel Aviv. It would also explain why the U.S. is sending a second aircraft carrier to the Eastern Mediterranean.
Right. Well, that's exactly where I wanted to go, Anne-Marie. Those aircraft carriers that are going over to the Mediterranean, one already positioned there. Do we have a sense of what the red lines are? And I keep going back to this for when the U.S. will get involved, when they will actually start to deploy the troops and the hardware that they've put floating on the sea.
Well, Admiral Kirby said right now, there's no reason for there to be U.S. troops, U.S. boots on the ground. The Israeli Defense Forces have the capabilities. They have the U.S. backing and supplies that they need. But these two aircraft carriers really just are a massive show of force. And you have the Eastern Med now, well, once the USS Eisenhower arrives there, you'll have the Eastern Med, you'll have it completely armed to the teeth. This is a huge deterrence to Tehran or any other actors that may want to get involved in this conflict.
Oliver Crook in Tel Aviv. I've got a clear understanding of how the Pentagon is related to Washington, to the executive branch and the legislative branch. I don't have a clue about the Israeli military. Who are they listening to now? Who gives the Israeli military guidance on this Monday?
Well, it will be this wartime cabinet that has been assembled by Benjamin Netanyahu, over which he presides, which has brought back together a great deal of the Israeli political spectrum, which again was the sort of main story when I was here last 7 months ago, the huge division within Israeli society that has really come back and coalesced in this wartime. Most of the government posts are in Jerusalem. The defense ministry is here in Tel Aviv. It's just behind me, actually. And so that's where the orders are going to be coming from. I mean, the defense forces will make their own sort of assessment in terms of how to execute, but it's going to come down from that wartime cabinet.
Anne-Marie, let's finish on this one. Israel was criticized by many going into the weekend for that 24-hour warning that it had given. You touched on the humanitarian corridors, water, electricity, fuel. AMH, what's the latest?
Well, the UN is out this morning with their update that these supplies are quickly dwindling and there's not really a lot left when it comes to Israelis. There does seem to be some clean water in some areas that were turned on by the Israelis for the Palestinians living in Gaza. But this is a dire humanitarian situation that individuals in Gaza are experiencing as they all, as well, try to flee. And some of them are even being blockaded by Hamas. And you know, if we learned anything from the 2014 conflict, it's that Hamas also will use humans as shields. They will store their weapons or have their headquarters in places like hospitals or schools.
Anne-Marie, is Egypt cooperating at the southern border?
Good question.
Well, it's very challenging right now. Egypt definitely wants a lot of aid from the United States, but Egypt also is saying if we let a lot of Palestinians in Gaza into Egypt, what does this mean for the future? How are we supposed to look after these people? They're under a tremendous amount of pressure to really get this Rafah border crossing open. At the moment, though, we are not seeing a lot of movement there, even though this is at the highest levels. President Sisi sat down with Tony Blinken over the weekend.
Tremendous reporting, Anne-Marie, as always, over the week and over the last few days particularly. Ollie, stay safe. It's good to hear from you. Ollie Crook there, over in Israel, in Tel Aviv. If you are just joining us, welcome. Plenty of diplomacy taking place, Tom, through the weekend, and talk this morning, based on our reporting, that the president might be getting ready to make a visit to Israel.
And on the southern border here, it's very important to say that there's one conduit, one gate, if you will, to go back to biblical times, where there can be an exit. The gate right now, I believe, Lisa, is closed. And to me, and this was actually the major theme at Morocco, was the place of the Egyptians in this, and it's a chaotic society. I mean, the demographics of Egypt and their financial standpoint is simple. They want U.S. aid as a bargaining chip.
Well, and they also are concerned about certain factions within their own population and how they will respond and what they might sort of be influenced by should some of the people from Gaza head into their nation.
And much more on this story through this morning. Coming up next, Sonia Martin of DZ Bank on foreign exchange. Your equity market slightly higher from New York. This is Bloomberg. Squeezing out a second week of gains on the S&P 500, coming into a new trading week. Your equity market positive, elevated by 0.3% on the S&P. The Nasdaq turning higher as well, up by 0.06. The small caps bouncing back. The Russell up by 0.75%. What a move in the bond market again last week, even with a single day. Remember, there was one day last week where the 30-year rose almost 20 basis points, and even with that, the 30-year yield was lower on the week by more than 20 over the week. Get your head around that. On a 10-year yield, higher this morning by 9 basis points, higher by almost 20 basis points, or lower rather, last week by almost 20 basis points. Keeping up to speed with this is absolutely insane, Bramo. 470 right now on a 10-year, 486 on 30s.
I've stopped trying to give reason to it. You can come up with your virtual reasons on one side or another, but it's such a hard thing to predict, which raises a question. Do we really understand what's behind this? And if we don't, to your point, I think it was a really good one, how can Fed officials lean on this so substantially and say it's not necessarily dysfunctional as doing the work for them if we don't really know why it's happening, why there is such an incredible amount of volatility?
Well, they certainly have credibility at the front end because the 2-year last week was essentially unchanged, even with PPI coming in hotter and CPI a little hotter as well. The 2-year right now just still in and around 5%. Even with economic data coming in just a touch stronger, TK, there is a belief that this Fed will be unmoved in November.
But again, the parlor game is open to the data. We've had some very important data. That jobs report was okay. And, the inflation data, we got as a retail sales tomorrow, I believe, fine. But the different narratives out there wrapped around the Dow 10,000, a 5% 10-year yield, I don't have a clue. I'm just waiting for the data.
If Chairman Powell wants to make the November meeting a live meeting, he has one more opportunity going into the quiet period this weekend.
David Weston could crowbar it out of him this Thursday.
David Weston, Chairman Powell, Economic Club in New York.
Chairman Powell, which way? Whether the 5% yield?
Just tell us.
Yeah.
Get the price target from Chair Powell. Looking forward, our good friend and colleague David Weston sitting down at the Economic Club in New York with the Chairman of the Federal Reserve this Thursday. We'll take that for you right here on Bloomberg TV and on Bloomberg Radio. Under surveillance this morning, Israel announcing another safe corridor in the Gaza Strip as it tells Palestinians to move south ahead of a potential ground assault. Egyptian officials confirming convoys of humanitarian aid are ready at the Rafah crossing, although it remains unclear when or if it will open. Gaza remains under siege, Lisa, with no supplies or power allowed in.
And we've been talking all morning about the uncertainty behind some of the negotiations. We've heard a lot about Rafah and the crossing there and how Egypt is negotiating with the U.S. and Israel to figure out how to let convoys of humanitarian aid in, screening them to make sure that they don't have weapons and other things that Israel is concerned about, while also letting nationals of the U.S. and elsewhere out of Gaza. It's really tricky, though, because how does Egypt justify letting a select number of Gaza residents out because they have relationships with other countries without igniting the anger of their own population who are protesting the fact that there is not an open border and that there hasn't been more humanitarian aid given?
These are modern debates. I mean, when we prosecuted wars in other times and places, civilians just simply were in the way, and it was tragic, and always in every case. I just am unsure for the Israeli military, what is the narrative they're listening to right now? I don't think that's been made clear.
I'll just say this, that if you talk to anyone in Israel, people are very united. They're very clear, especially given how many people were killed, how they were killed, how many people were abducted. There is a clarity in Israel, complete disagreement politically, but a clarity among Israelis about what they want to do.
The website doesn't matter, but it's an acclaimed global newspaper, John, and the answer is there were 8 or 9 narratives lined up collegially because these are the 8 or 9 narratives of the moment. I don't think the Israeli military has 8 or 9 narratives right now.
Lisa mentioned that domestic support in Israel. Domestic support here as well in America. We mentioned this poll in the previous hour. I think it's worth going over again from CNN. Ahead of this expected ground invasion of Gaza, most respondents to this poll, Americans, said the Israeli government's military response to the Hamas attacks is fully justified. That was 50%, partially justified 20%. A total of 21% said they weren't sure. Tom, only 8% said it was not justified at all. I think it bears repeating what we talked about in the previous hour. All through the weekend, there's been talk about controversial stories on campuses at American colleges, a lack of support for Israel. That poll, Tom, does not speak to that at all.
Well, no, the poll doesn't talk the narratives that you're seeing out there at all. And of course, you have to see how the poll adjusts, and it awaits the Israeli actions that clearly in the last 24 hours, but frankly, even 48 hours that we've been waiting for on a Monday. Who knows? Do I care what the Secretary of State's doing right now versus What is the Israeli military thinking? I don't know the answer.
Escalation abroad. We've talked about dysfunction at home. Let's do that again. House Democrats now looking for a bipartisan solution to find a speaker. Minority Leader Hakeem Jeffries telling NBC, quote, there have been informal conversations. When we get back to Washington, it's important to begin to formalize those conversations. Democrats have refused to vote for a Republican speaker after Congressman Kevin McCarthy was ousted earlier this month. Final story for you. The US looking to further restrict China's access to advanced chip technology. We're reporting new measures will close loopholes and make it harder for Chinese firms to get chips and chip-making equipment needed for AI. The Biden administration expected to make the announcement, Lisa, early this week. So we're getting a lot done all at the same time down in the White House.
We're getting a lot done, raising some questions about timing. When I read this, I'll be completely honest, I wondered if this had been in the works for a long time. They were asked to be a little bit harder with respect to some of those restrictions, whether this came out now and whether the timing is somewhat inconvenient at a time where it does muddy the waters of diplomacy. A lot of people looking at China and saying, okay, well, how are you going to keep things from spiraling out of control in the Middle East? Well, this doesn't really necessarily help the cause. At the same time, it's after the phone and them and China showing that they can develop their own chip technology. So a lot of uncertainty about the timing to me.
It is October 16th. If you went through the week ahead guidance for the White House, it read as follows. The president will travel to Colorado to visit CS Wind, the largest wind tower manufacturer in the world. This headline just crossing, Biden's trip to Colorado is postponed, will be rescheduled. The latest on the president's movement, Tom, ahead of a key week in terms of diplomacy and potentially military action, one, but also two, in the context of a report that we've put out earlier on today, indicating that there is a consideration at the White House for the president to make a visit to Israel. It's up to you whether you draw a line between the two stories. I'll just give you the news. He was going to Colorado today. It's been postponed. Tom, it will be rescheduled.
I think it's very fluid here, and all we have left is up 9 basis points as the 10-year yield is, dare I say that U.S. 10-year is a thermometer of where we are right now. 10 basis point move, 4.70% on the 10-year yield. This is a joy because this is what we do at Surveillance. We go deeper. The stereotype, particularly for our U.S. audience, is Deutsche Bank and maybe Commerzbank is banking in Germany. Anybody who's a student of it, like, say, Adam Posen, would say, well, that's not quite true. John, you're going to love this. The Deutsche Zentralgenossenschaftsbank.
Nice. DZ Bank?
DZ Bank. DZ Bank is really important in Germany as a cooperative bank of millions of voices. Sonia Martin joins, FX and monetary policy head of DZ Bank of Germany. Sonia, wonderful and well-timed to have you on. How do you link what is clearly a slowdown of economic might in Germany to a weaker euro?
Well, yeah, it is somewhat surprising. We have seen, a lot of very weak data for some time now. I mean, I think there is very much clarity on the fact that the Eurozone is really struggling. And I think the data that we're going to see this week is only going to confirm that. Yet, we have seen Eurodollar falling. And I think, to be honest, that's a combination of two factors. We have seen, on one hand, the softness in the Eurozone, but I think also very much this is a dollar story. We have seen people become, increasingly optimistic on the US. I mean, all those recession fears have sort of gone out the window, really, haven't they? So I think that's kind of been the driving forces in that currency pair for the moment.
Sonia, I was scheduled to speak with Joachim Nagel in Marrakesh, and he unfortunately had to cancel that meeting due to really pressing issues right now. What are the pressing issues of the Bundesbank as they look at foreign exchange and, again, the real economy slowdown in Europe?
Well, I mean, everything else being equal, obviously a softer euro is not exactly bad news. In fact, we might very much welcome a somewhat softer currency in this general global environment because, we still are very much, if you look at Germany, an export nation. So, we're going to benefit from a weaker currency. At the same time, the problem is, of course, that with a weaker currency comes potentially more inflation. And that's, of course, something we don't want to have right now. We want inflation to come off, the recent highs. We want it to come back to these targets. So this is kind of a bit of a juxtaposition. Weaker currency, yes, but not too weak, because then we have an inflation problem again.
How much are we hearing, Sonia, a sense of ECB members following along with what the Fed said, saying the bond market's doing the work for us, so we don't have to raise rates on that much further?
I think it's interesting. I think you mentioned earlier as well. It's interesting the way that the Fed has phrased this, because in a way, by saying the market is doing the job for us, what you're really saying is we don't have to hike rates more. They may not have to stay high for as long, and that ultimately could, of course, end up depressing rates again. So it's a bit of an odd way to phrase it for them, I think. This is not something that we've heard very much about in the Eurozone. I mean, the ECB hasn't really spoken about, anything in that kind, the market is doing the job for us. That hasn't really happened here. I think the big discussion that's happening in Europe, in the ECB right now, is this division between the hawks and the doves, and the question of, yes, we no longer see any need to hike rates further, but we need to talk about other measures to reduce excess liquidity. We need to talk about PPP reinvestments, et cetera, et cetera. So that's the big debate that's happening, I think, at the ECB at the moment.
A lot of people also are wondering when the market will really reflect some of the angst that we've been talking about all morning in the Middle East. There isn't necessarily a clear read-through unless oil starts to get involved. And if oil prices spike, just how vulnerable is the euro?
Yeah, it's always odd, isn't it? I mean, there's something happening that's so dramatic, and the financial market takes a sort of very, I'm going to say, jaded view. We don't really care as long as it doesn't affect the oil price. I mean, it really is kind of bizarre. But yeah, that's evidently what's happening. As long as, oil isn't involved, then the bigger impact on the financial market isn't really going to be huge. If oil gets involved, this is going to be a big problem, because of course, as we have discussed, we're just coming out of a high inflation era, and we're going back to hopefully towards more normal inflation rates. And the last thing we need, both on the inflation and the growth front, is of course a surge or lasting surge in the oil price. And that's, because that will be detrimental really both to growth, and it would obviously also push inflation rates high again. So the worst of both worlds really.
Taking the temperature for the potential of broader escalation in the region. Crude right now, 90.65. A little softer on the session. Sonia, thank you for being with us. Sonia Martin there of DC Bank. Just an update on the news we got just moments ago. The president had been due to travel to Colorado to visit the largest wind tower manufacturer in the world. The latest we understand from the White House, the president's trip to Colorado is postponed. It will be rescheduled. The president will remain at the White House to participate, Tom, in national security meetings. That crossing just moments ago.
Well, it's got to be that, and in real time as well. And also to the diplomacy, and what he can affect is in talking with allies, less talking with Israel and talking with, there's intractable issues here that Israel's going to do unilaterally. But the real question here to me is, what does he do in dialogue with the allies, such as Mr. Scholz of Germany?
If you are just joining us, welcome to the programme. The S&P 500 shaping up as follows this Monday morning, positive by 0.3%. Crude a little bit lower by 0.1%, 87.58. The team here at Bloomberg, Jennifer Jacobs, Justin Singh, reporting the president is considering a trip to Israel. This line is important, though. According to two people familiar with the internal discussions, Lisa, no decision about whether to travel to Israel has yet been made. That was our latest reporting. Indications this morning that trip to Colorado postponed because the president will remain at the White House to participate in national security meetings.
The security around some sort of trip like that has to be pretty shocking. I was reading over the weekend all the stories about how the Tel Aviv airport remains open at a time where they are fending off certain kinds of attacks. The question that I have on a broader level is just that we don't know what is holding back the ground invasion. As you said, we don't know the state of the hostages. We don't know how many of them are Americans, and we don't know the red lines that either Iran, Hezbollah, or the Hamas militants could cross before the U.S. gets involved, before some of the other nations in the region get involved.
This is our new war. Could you imagine LBJ slipping away to Vietnam, or having a debate of dashing off to Vietnam, and many other
what Lisa's getting at is important
well.
here, TK.
Yeah.
Is it a distraction? Is that the kind of security distraction that country needs at the moment, which will be part of this consideration, I'm sure, on the ground in Israel? Coming up next on the bank earnings still to come this week, Eric Najarian of UBS.
I think operationally, this was a good quarter, both on the consumer and commercial lending. One scenario that hasn't been talked about, with the Fed possibly with a rate pause, is that with rates staying high, and if the banks can hold the line in terms of deposit costs, they can enjoy net interest income growth.
JP Morgan has been enjoying that net interest income growth. That was Ken Leon, Director of Equity Research at CFRA, following results on Wall Street on Friday. More still to come. Before we get there, let me update you on the president's movements. He had been due to travel to Colorado to visit the largest wind tower manufacturer in the world. The latest from the White House, this quote right here: the president's trip to Colorado is postponed. It will be rescheduled. The president will remain at the White House to participate in national security meetings. Our reporting here this morning here at Bloomberg that the president is weighing a trip to Israel. No decision, according to two people familiar with the internal discussions, no decision about whether to travel to Israel at this point, Tom, has been made.
Well, it hasn't been made, but to Lisa's delicate point, and I think Lisa said this with immense respect, I mean, do we need a distraction of this? Pick the geography of Israel right now. I mean, it's not something for me to spout about, but certainly it will be part of the zeitgeist over the next 12 hours.
Well, there's two very, very simple options, Tom. Distraction, one, potentially. Two, talk about display of support, Bramo, for the President of the United States to go over to Israel at this point.
And a lot of people said that Tony Blinken and his words and the show of support and the aircraft carriers, et cetera, have been incredibly heartening for those in Israel. There is a question, though, about how much this complicates some of the other diplomatic relations as well at a time of incredibly delicate negotiations. We can't emphasize this enough at a time where a lot of governments of some of the Middle Eastern nations are not in total alignment with the majority of their populations, which are increasingly having protests.
A weekend of really intense diplomacy. Much more on that throughout this morning on Bloomberg TV and radio. If you are just joining us, your equity market looks like this on the S&P 500, positive by 0.4%, yields higher by 9 basis points on a 10-year, 469.97. The next couple of days for bank earnings shaping up as follows. Bank of America just around the corner. That's a big one to watch. That stock absolutely hammered. B of A down something like 20% TK year to date. Goldman Sachs coming up tomorrow as well. Then it's on to Goldman. Past that, it's on to Morgan Stanley on Wednesday.
They all have value, but I'm fascinated, John, by what Mr. Moynihan does to provide fixed income price clarity across his ginormous platform. And one outcome is to say, wait for next quarter. Maybe it won't be visible here, but it'll be visible 90-day report hence.
This quarter for JP Morgan, Tom, not bad, eh? Boosting the outlook into year-end as well.
It was terrible. I mean, they're struggling, and, it's tough.
Wasn't that a record quarter for net interest income?
Yes.
Joyce Chang showed up on stage with a cast on one of her ankles. She tripped over a concrete block at the construction site.
Really?
Yeah.
In Morocco?
Yeah. No, she tripped over a concrete block at the construction site.
You're making up stories, aren't you?
On Park Avenue.
Okay.
No, I would never do that.
Just in case any relations of Joyce are listening, Joyce is okay and hasn't tripped
Joyce is okay.
Why are we doing these
No
things?
idea.
Joining us now to save the show, Erica Najarian, large cap banks and consumer finance equity research analyst at UBS. She is not wearing a cast on one of her ankles this morning. Erica,
How do you know?
I did. Thank you. I look, Erica, at where we are right now. And if I look at the Keefe Bruyette Index, we're down 48% from the nirvana that we did in 2022-21. And we've only got 26% down to go on a blended bank basis to get to COVID lows. What do they do to turn the ship around?
So it's pretty simple. And I think that they essentially have to disprove the negative, which is that higher rates is only bad for banks, or higher rates are only bad for banks. As you could see in the earnings results so far, that's not actually the case. A lot of these banks have the raw material to make more money in a higher interest rate environment, which is a good deposit base. But what we've seen early this year with the 3 bank failures is the dark side to higher rates. What happens when you're offsides and rates go up faster than you think? And so what the market really needs to see is you're not seeing massive capital losses, you're seeing deposit stability, and you're seeing net interest income progress in the right, in the right direction as they earn more on their assets and their liabilities.
I mean, correct me if I'm wrong, but Erica, the history to me is called synergies or cost cuts or moving things. Are they to the bone now where they can't cut anymore? Are they going to choose which divisions to participate in into 2024? Or is it just going to be, cut 4%? Let's go.
I think that might not be the right question to ask unless it's someone like Citigroup that has a very specific expense cutting plan. Keep in mind that these banks are actually making a lot of money right now. They're making a lot more in net interest income than they did last year. Trading has been resilient. Investment banking is cyclically depressed, but could bounce back. And so, a lot of these banks understand that you can't necessarily cut your way to glory. And so while we think they're going to be mindful of expense growth next year, I think that the question really is how do they, think about revenue resilience next year? How do they, maintain deposit costs at a certain level if the Fed does pause in order to enjoy fixed asset repricing? I think the question is more about keeping deposit costs, or rather keeping operating costs at a lower growth rate than revenue growth, rather than outright expense cuts at this point.
Erica, they're making bank. Let's be honest, right? They just had a record quarter, as John was mentioning, for net interest income. If they are doing so well and they have surprised the upside and they're not putting as much to the side to cover loan losses as many people expected, why aren't the shares doing better?
Because a lot of investors are still really fearful of what could be the consequence of higher rates, and the rapid increase in rates, which is a recession. And at the end of the day, a lot of these banks are, like you say, making bank from a revenue perspective, especially on net interest income. But a lot of investors are fearful that we'll see higher credit losses, whether it's on the commercial real estate books or, corporate books or, the consumer weakening. So right now, the valuations are staying cheap because a lot of investors are essentially saying, well, I'm going to wait till I really understand the complexion of the downturn before I really step in and, really call these stocks inexpensive.
So how much are you getting pushback? How much are you recommending to investors to buy certain bank stocks and making the argument they're undervalued because of this uncertainty, and yet they're increasingly acting like utilities because of how much capital they've put aside and how regulated they've become?
Look, I think the reality is that the banks are in a little bit of a trading range at this point. So, you brought up 2 points. One is macro and one is regulation. Near term, we do think that the rubber band has stretched a little bit too far and they're at the low end of their trading range. And they are a little bit too inexpensive, relative to the reality of their earnings power today. That being said, you bring up a good point. Not only is the uncertainty over the economy really tamping down what their multiples could be, right? But also you have a lot of new rules that are coming down the pipeline. That being said, I like to describe the new rules in terms of what's coming down the pipeline as tough, but not nearly as, game changing as it was coming out of the financial crisis. If for money center banks, the regulatory landscape went from 0 to 10. I feel like Basel III Endgame and the upcoming liquidity rules, it's going from 10 to 12. And perhaps from regional banks, it's going from 8 to 11.5. But either way, I think what I'm recommending to investors is, look, take advantage of these prices at the low end of the trading range, but valuations are not really going to be able to re-rate meaningfully to normal levels relative to the broad market until we get more certainty, more clarity on what the economy looks like over the next 12 months.
Erica, good to hear from you again. Let's do it again soon. Erica Najarian there of UBS going into bank earnings tomorrow and Wednesday. The likes of Goldman, Morgan Stanley, Bank of America still to come this week. Big question for us. Can this administration, this White House, this country afford an escalation on 2 fronts worldwide? Peter Chi of Academy Securities is going to join us in about 5 minutes' time. The President of the United States said this over the weekend to 60 Minutes on CBS. We are the United States, the most powerful nation in the world in history. Went on to say we can take care of both of these and still maintain our overall international defence. Janet Yellen, the Treasury Secretary, was asked the very same question by a British broadcaster, Sky News. She said this, Tom: America can certainly afford to stand with Israel and support Israel's military needs, and we can also and must support Ukraine in its struggle against Russia. What do you make of the very fact that this is a question that's being asked of this administration, this government?
It's always, in American history, John, it's always been asked. This is true of all of American history. And what was interesting, and Yellen was incredibly visible at Marrakesh, and some would suggest hardworking on the theme. She was there. She's in Luxembourg at the finance ministers meeting. I believe it's this morning. But John, the key thing here for Janet Yellen is American exceptionalism. We really stick out for growth that we can afford to support these two war platforms.
Peter Cheer of Academy Securities on that story up next. Your equity market right now positive by 0.3% from New York. This is Bloomberg.
The reason why people, including ourselves, have been too bearish on the market is that we've seen a slowdown coming and it hasn't manifested.
I'm still in that rolling recession camp. Indeed, in some areas, it's starting to look like a rolling recovery.
In the short term, I think there's an investable market rebound here.
The Fed is going to be a very muted player whenever that deceleration in the economy does arrive.
Until we hit recession, we are probably not going to see a definitive macroeconomic narrative driving the market.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene on radio, television, across this nation and worldwide in this hour. Peter Cheer to be with us in a moment. Economics, finance, and investment. No, John, it is oil. It's a single metric we have, bouncing off $91 a barrel Brent crude on the geopolitics, the war of the Eastern Mediterranean.
That is taking a temperature right now of the potential for escalation in the conflict between Israel and Hamas. Right now, $90.68 on Brent crude. At the moment, the challenge for investors, how on earth do you do this? Process two opposing ideas simultaneously. When a bank CEO turns around and says this may be the most dangerous time the world has seen in decades, then the very same bank reports a record quarter net interest income, Tom, and boosts its outlook.
You're going to see that. You're going to see this partition here of business as normal, maybe even in America, a better than good real GDP against these two war platforms. On the break as we begin this hour, we were talking about how you have two war platforms, and the president fully focused on national security today. We'll address that.
That's the international story. Need to talk about the domestic one as well. Important economic data this week, Tom. Retail sales come up tomorrow. Tons of Fed speak. It's worth talking about this again. Chairman Powell sitting down with David Weston, Economic Club in New York, on Thursday. The last opportunity for the Federal Reserve to indicate what they may want to do on the 1st of November.
My guess is Chairman Powell will say, first, do no harm. But we'll have to see on that. Lisa, which Fed speaker has your closest attention?
Well, it has to be Powell. Do no harm. What does that mean at this point when you have a question around whether the Fed has lost control over the long end of the yield curve? Do they just keep leaning into this message? It's doing the work for us. The more it bounces around like a ping pong ball, the more that we can step back and not raise again. Either way, I don't know how much we're actually going to get some sort of definitive statement from him other than his balance of risks right now.
Lisa, your thoughts here as we go into a Monday midday in Israel, your thoughts on all the news flow of the last literally 12 hours.
It's a fog, and it's unclear why there hasn't been an escalation the way that Israel had promised in terms of the ground invasion. It's unclear whether Iran and the discussions, the back-channel discussions that they had with the U.S. were successful. What is clear is that there is a feeling of high tensions and that this could potentially explode into a broader Mideast conflict that a lot of people would like to see avoided.
The markets do trade on a 10-year real yield now, elevated by 6 basis points, not out to new real yield highs, but John, 2.34% shows the cost there of capitalism right now.
For all that stress abroad, for all that tension in the Middle East, for the tragedy we've all seen disturbing pictures from, Tom. This equity market was up last week for a second week of gains on the S&P, up a third of 1% this morning, helped out by developments in the bond market, yields lower by almost 20 basis points on a 10-year last week, more than that on a 30-year last week. The 10-year this morning up by 9 basis points, Tom. Let's call it 470 on a 10-year this morning.
Just one item, John, 149.53 on dollar yen, really not breaking through to the tension of intervention or some process in Japan, but nevertheless not giving way to strong yen. We haven't seen that.
That's really not on our radar anymore, is it, Tom?
No,
still
it isn't.
In and around 150,
said.
though. We're still right there, 149.53.
A hugely popular guest, and I don't mean popular in terms of fun and games. I mean insight and intellect. Peter Cheer joins now, head of macro strategy at Academy Securities. Peter, you were on fire last time. It was just really brilliant about the dovetail of all these narratives. How has your narrative changed, say, in 10 days?
Well, we're all having to process what's going on with Israel, Hamas, and the Middle East. So that's probably been the biggest change. It's been clearly a very sensitive issue. We think it's playing out right now kind of as it should, that Israel will eventually, secure their borders. They will make sure that it is safe for their citizens, but they'll do it in such a way that it doesn't escalate this conflict beyond relatively small borders.
Localized, Pete, is that the word that comes up with clients again and again and again? Is there a belief that this can remain localized?
Yeah, I think that is the belief, and I think that's what the market is pricing in right now, and it's rightfully so. Israel certainly has the capacity to eliminate the threat. They said they will eliminate the threat, but I think it's very positive that they are doing this carefully and cautiously to minimize civilian casualties. The two risks kind of that aren't priced in is an escalation with Iran. It seems like we're trying to take some backdoor channels to keep that threat low, or that something spurs the change in sentiment in Saudi Arabia. Saudi Arabia has been making a ton of progress in terms of westernizing their economy, in terms of the Abraham Accords. So we're watching that very carefully. And that's probably the main reason Israel is being very cautious as well.
Pete, do you believe America has the capacity to support two military conflicts simultaneously?
We do, but as some of our generals, General Teptula has been very on top of this for a while. We have been underfunding parts of the military, so we're going to be a little bit stretched. Two fronts, I think, is fine. It does leave us a little bit vulnerable. We are going to have to see a massive replenishment of our weapon systems as we've been, providing weapons to Ukraine. It looks like we're going to help Israel in terms of refilling the Iron Dome weapons. So there's going to be a lot going on the defense side for the next years to come at this point.
When it comes to refilling all of these supplies, it does take money, and something we've been talking about. Is there an appetite to expand defense spending at a time where borrowing has gone up and interest payments are going up as well? How does that factor into your calculus at a time where a lot of people are not fully understanding some of the gyrations in the long end of the yield curve?
The one thing, so we've got the 18 retired generals, admirals, and 2 astronauts to get to work with. The unified message we get is that in terms of national security issues, DC is actually very bipartisan, very smart, right? You do not get to sit on these high-level national security committees unless you've demonstrated intelligence, bipartisanship. So I'm actually very comfortable that when we have these real threats, we will put together and do the right things. So there will be spending, it will be well done, and it's necessary. And we have to kind of reinstate our influence in the globe, which has been waning.
One thing that you do really well is you game out what is priced in and what isn't priced in. You said earlier that some sort of escalation with Iran is not being priced into the market. How would it be priced? How do you see it percolating out in the market? Should there be some sort of expansion in the region with either Iran's, some of its proxy fighters, or just the nation itself?
I think then you definitely see oil hit above 100, and more importantly, it wouldn't just be a short-term spike. I think you'd start seeing futures build out at a much higher price for a year or 2 years. And that had given us some comfort on some of these recent spikes. It was much more consolidated in the front end of the futures contract, not some of the longer-dated contracts. But if we really are going to impose sanctions on Iran, if they are going to potentially disrupt oil flow in the Middle East, that would have a much more serious impact. And I think the bond markets can kind of shake off what's currently going on. But that would probably push yields higher as we would be facing much higher oil prices for much longer.
Peter, within economics, finance, and investment, you are a student of history. Amid war, as a general rule, what do stocks do?
I think they get volatile and they're fluctuating when there's a lot of uncertainty. But once it looks like the path has come through, we generally tend to rally. I think we had that just recently with Russia and Ukraine. There's that initial fear factor. And then as people say, okay, this is what it looks like, this is how it's controlled, this is what we do about it, we can rally. And again, position was fairly light, I think, coming into this. So I'm not surprised that we can get a nice rally if we maintain the status quo and Saudi keeps making the right signals and Iran doesn't escalate this.
Yeah, I look at the catharsis required, and I'll let somebody else smarter than me determine if we've had bond catharsis, but I think we can certainly say we have not seen equity catharsis. Is that required?
We saw so much equity catharsis last time around, in the last year, so I'm not sure how much catharsis there is left to have. So it's hard to get super bullish, 4,500, 4,600 in S&P seems tops, maybe 4,200 I think seems to be a bottom right now, unless something happens in the Middle East.
What are you hoping to hear from all of the Fed speakers? Do you think that they are that important at this point with such heightened uncertainty as we get the last gasp before the quiet period?
I think they're going to make it very clear that the data has not been consistently strong enough to hike, that they really don't want to hike. I like the fact that they're talking about real yields. We've been talking about that for a couple of months of how important that is. We are starting to see this filter into the economy. We're hearing more and more, I don't want to say horror stories, but stories of companies that were borrowing at 7% that are now facing 14% as their debt matures. So I think they're supposed to pause and let this play out, especially now with this global uncertainty.
Well, the global uncertainty is there, but then it's by straw hats and winter. What are you acquiring today? I mean, I'm assuming you're not 100% in cash, so what do you buy?
I like bonds again. We've been trying to rate range this as, we got to 480. You want to buy a lot of 10s. As you get back to 450, you sell some. Same on the stocks, right? It's kind of that range. As you start pushing towards 4,500, you want to be reducing risk on the S&P. As you get below 4,300, you want to be adding. So I think it's a trader's market. And you do want some hedges. My favorite hedges right now, I think, are buying calls on treasuries, because if we get this geopolitical escalation, although oil is going to go higher and Fed can't ignore it at the front end, I think the back end is going to start pricing in a true flight to safety trade.
Pete, how are you getting a read on the potential for escalation? If there's one particular voice you're following at the moment, whose voice is it?
There's not one particular voice. So we're searching around. And again, I've got the luxury that we've got 16 specifically generals and admirals who are retired who are talking to people across the U.S., across the world, to the IDF. So we're trying to distill this information that we get, and that's what we're trying to look for, these tiny little signals that aren't on the radar screen. So it's a little bit tricky, but I think we're trying to manage it pretty well.
Peter Chair, managing it very well. Thanks for being with us, sir, at Academy Securities. Pete, appreciate it as always, mate. Just to update you on the president's movements, the latest from the White House, the president's trip to Colorado was scheduled for today, postponed, will be rescheduled. The president will remain at the White House to participate in national security meetings. If you are just joining us, welcome to the program. Plenty of movement in this bond market over the last couple of weeks, that's for sure. Over the last 5 weeks, we saw yields higher. Last week, finally lower on a 10-year, on a 30-year by something like 20 basis points across the board. On a 10-year this morning, higher again by 8 basis points. So try and keep up. 469.56. Crude just nudging higher by 0.2%. Worth a look, given what we just talked about with Pete. 87.88 on WTI, 87.85. And if you are just joining us, the equity market on the S&P positive by 0.25%. Plenty of earnings still to come. Economic data, Fed speak, tons of that. Chairman Powell on Thursday. Julia Coronado of Macro Policy Perspectives, 8:30 Eastern Time. We'll catch up with Julia Tom in about 18 minutes' time.
I think it'll be fascinating to see what she says about the choice side. And frankly, I want to get, Lisa mentioned there's 14 Fed speakers today. Julia should be one of them. And the answer is, how do they message this within war? And they've got to be saying they have less confidence in their guesstimates. To me, that's the heart of the matter.
Well, the idea of uncertainty being a policy is kind of where we're at. What Peter Scheer just said there, though, is really interesting, and it's something that we heard maybe from Jay Pulaski as well, which is treasuries are still a haven trade. And it's unclear whether we're seeing that play into all of this, but when there is uncertainty, at some point, the buying will start to come back in. And we keep hearing that from a number of different guests. But have we seen that? I mean, this is sort of a question. Would we see even higher yields this week, last week, if it weren't for some of that uncertainty hanging over markets?
Would you like to go through the Fed speak for the next couple of days?
I'd actually be dying to. Please, help us out.
Harker, Williams, Bowman, Barkin, Kashkari, Waller, Williams, Bowman, Barkin, Beige Book, Harker, Cook. That gets you through Wednesday. And then you go on to Jefferson, Powell. This is ridiculous. Goolsby, Barr, Bostic, Harker, Logan into the quiet period that starts this weekend.
When is a quiet period? It can't come
Saturday,
soon
I
enough.
believe. I believe it kicks
3
off this
p.m.
weekend.
this afternoon.
I have to say, that was gold. Harker.
Oh, killing me.
Beige Book.
It's ridiculous. He'll be reading the Beige Book. You know that, Brownlow.
Oh, yeah.
Terry Haynes of Pangea Policy on the
Kindle
dysfunction
version.
domestically here in the United States, facing the prospect of escalation internationally. Your equity market positive by 0.25% on the S&P. From New York, good morning.
We say this to the Israeli people. We have your back. We feel your pain. We ache with you. And we and our country will stand by you in these difficult times. And I, along with my colleagues here, will lead the effort in the United States Senate to provide Israel with the support required to fully defend itself from this monstrous attack.
Senate Majority Leader Chuck Schumer there speaking in Tel Aviv over the weekend. From New York City this morning, good morning and welcome to the programme. Your S&P 500 is positive on the S&P, inching higher by 0.25%. Yields are much higher again by 8 basis points, 469.56. The Nasdaq doing okay, even with a move lower on Apple. Check out Apple in the pre-market, just a bit softer this morning, down by something like 0.8%, 0.81% lower. Apple's new iPhone 15 selling far worse than China. According to some research, sales of Apple's flagship device down 4.5% compared with the iPhone 14 over the first 17 days after release. This according to market tracker Counterpoint Research, their estimates and previously unreported figures provided to us here at Bloomberg News. Tom, the stock a little softer, down by 0.75%.
That article out of our Asian platform, not Mark Gurman. I, of course, emailed Mark Gurman to get his view on this. He is absolutely authoritative on all things Apple. We'll have to see. But it's clearly a very discreet statement on counting of phones.
If it's true, if it's real, if it's the reality of things and where we'll end up in the quarter, is that because of sluggish consumer spending in China or because of competition? Which one is it?
I think competition was in the article. I don't know. I'm just not qualified at that. But this is the kind of angst you've got on Apple. It's exactly the same angst 6 crises ago on Apple.
Analysts over at Jefferies, Tom, sort of echoing this as well.
Yes,
Reckon sales of the iPhone 15 were down by an even sharper double-digit percentage from its predecessor after Huawei unveiled this new beast over in China.
We've got 8 ways to go here now, John, and we're going to do this with Terrence Haynes, founder of Pangea Policy. He's been of huge value of how Inside the Beltway is amending to what he calls geopolitical risk at a half-century high. That is a sobering statement, to say the least. Terrence, I don't even know where to begin this morning. I guess I'll begin with the immediacy of a president considering going to Israel. LBJ really didn't do that in Vietnam. Pick your other presidents along the way. What is new about this new prosecution of war?
Well, there's a lot of personal diplomacy involved here, and one of the things the White House is considering almost certainly is that the president's presence in Israel might help that to happen. There's that on the one side. On the other side, the president was interviewed on 60 Minutes last night from a Thursday taping, and we were told by CBS not once but twice how tired he looked or seemed. And so on the other hand, you got to understand that the president needs to conserve his own energies, and that might be best done in Washington.
From where you sit, does the president have the support of some form of our legislative branch, or are things so fractured that it's an executive branch alone?
No, I think there's a good deal of support. The difficulty is that one of the things Biden wants to do this week is send up a combined aid package for both Israel and Ukraine. I think that fractures on the factions in both parties that I talk about frequently. And number one, so it really makes it more difficult. Secondly, you're going to see a rare public prosecution of the administration's Middle East strategy and Iran strategy directly when Jack Lew goes up before the Senate on Wednesday for a confirmation hearing. And I think his nomination right now is in some peril. But we're going to have a full-throated discussion and debate about this in public, which is rare, but probably good for the American public and for Biden.
Can you elaborate on that, Terry? I mean, a lot of people are wondering whether dysfunction in Washington, D.C. limits the U.S.'s ability to respond to a crisis that you think has the potential to be the worst that we have seen in 50 years of geopolitics. How much do some of these internecine fights threaten the U.S.'s ability to adequately respond?
I think less than is bandied about by newfound experts on House process and procedure. Bottom line is that the Speaker, the pro tempore, the temporary Speaker, can do, according to House rules, can use whatever powers are necessary of the speakers. There's a choice being made here, basically by both parties, that until a new Speaker is is established, they don't want to test that. But if we had an emergency, say the need to provide immediately for Israel, immediately in Ukraine, or even activate our own war powers, almost certainly the House would be able to do that and do it very quickly. So I wouldn't, honestly, I wouldn't worry about that.
We have been talking about how the U.S. will keep probably spending, and that there isn't a lot of appetite in D.C. for restraint at a time of a number of different conflicts and just domestic concerns. How much are we seeing, from your vantage point, a doubling down on that with respect to additional international aid and restockpiling of weapons in the U.S.?
Well, I think in the end, you're going to get both an Israel aid package and a Ukraine aid package. I do think that takes probably another couple of months, though. As I've said to markets, and I think I've said on this program, the failsafe really is the end of the calendar year, because that's when the regular defense spending and defense authorization, kind of think of it as priorities, legislation finishes. Until you get to that point, there's no real forcing event that requires anybody to make a decision, whether it be on domestic spending or on aid packages.
Terry, to the war in the House of Representatives, I'm trying to find a history analog here, and I can't get there. The Democrats maybe are going to help out centrist Republicans. What's their key ask?
The Democrats, I don't know. They haven't said, and I suspect they don't want to say. What they are saying is, well, gee, we could band together with the temporary Speaker McHenry to expand some of those powers. The difficulty here is that Republicans want to come together around a speaker. McHenry thinks of his role as purely ministerial until the time comes to elect that new speaker. And as I told markets yesterday, I think what ends up happening is Jordan doesn't make it, and the best compromise candidate will be arrived at, and that's probably McHenry, something he doesn't want but is going to get thrust upon him, I suspect.
Terry, you nailed it last week. I think we've got to repeat that. Last Sunday, waking up Monday morning to the massacre that took place in Israel, there was a sense that we could maybe address the dysfunction down in Washington, that perhaps we'd increase the odds of getting a speaker, reduce the odds of seeing a shutdown. You said those people are wrong. Terry, that ain't going to happen. Just on the shutdown, in any way, shape or form. Terry, does it reduce the likelihood of a government shutdown, given the aid that some of these places need?
I think not today, but we're a month away from that. I think the aid packages are going to be hotly debated. We'll make some accommodation for that. But initially, and the White House has said this, by the way, so it's not just me. Initially, there are lots of things they can do without needing additional kind of formal congressional legislation, particularly on Israel. I mean, we've already got 2 carrier groups over there, so of course they're going to be supplied and whatnot. But those aid packages are going to go through in the succeeding weeks. But the dynamic, the imperative hasn't really changed in Washington, and I think what you'll see is the House stumble through another week before coming up with a compromise candidate. A
nice bath for the happy talk in Washington over the past week or so. Terry, thank you, sir, as always. Terry Haynes there of Pangea Policy.
He's just so well attuned to politics. Whatever you think of his angle in politics and all that, just there it is, the word compromise. How quaint. How ancient.
Let's see if we can get one of those.
Yeah.
In the next hour on Bloomberg TV, here's the lineup just to get you set up for the trading week. Tons going on, lots of earnings, lots of economic data, tons of Fed speak as well. We'll do that with Jim Karen of Morgan Stanley, Mira Pandit of JP Morgan, David Bianco of DWS, and to get you set, prepared, ready for the bank earnings over the next 48 hours, Jason Goldberg, Tom, out of Barclays.
Yes, the bank earnings to me are fascinating, and I'm really attuned, John, to the conference calls, and do they say we need to wait another 90 days to really understand mark-to-market dynamics versus bond price loss?
Particularly for the likes of Bank of America, where there seems to be a big focus on that in the market. From New York City this morning, this is Bloomberg.
Bloomberg surveillance with markets on the move. Equities, bonds, currencies, commodities, and the commodity of note is oil. Lisa Abramowicz, Brent crude just spiking. That overstates it. Let's call it a lift above $91 a barrel, $91.34. That's a high in the last number of days.
And it comes after Friday's move, I believe, on Brent of 5.7%. So a real pop there. People feeling out the situation, some tit for tat going on, rhetoric that's hard to understand. Again, parsing through some of the chest thumping, how far are diplomatic efforts really getting? And we don't really have a sense this morning.
Well, we don't, and we'll look at the news flow as we can. And again, balance of power this evening. Joe Matthew, Anne-Marie Horton, and team will give you the latest of Washington. Right now, with the green on the screen, I've got futures up 11. I got a VIX under 19, so it's a more constructive volatility index, 18.85, 210 spread. I got a lift of 6 basis points. I'm watching the real yield, not as real as it was a few moments ago, 2.31%, but that gives you a sense of the character of the market. Dollar fractional weakness. There's nothing ever weak in the analysis of Michael McKee, our Bloomberg International Economics and Policy correspondent. He and I watched together the Jets' big victory yesterday, which was a nice relief from all this news flow. And what we're seeing, and the heart of it is, we try to get a pulse of an American economy that seems resilient. Are we going to see a resilient retail report tomorrow?
In essence, the feeling is we will see a solid, if not resilient, report. A little bit slower than it has been, but still Americans are spending money. We just got the Empire manufacturing numbers in, and while the headline number goes down to negative 4.6 from 1.9, we saw prices paid fall, prices received fall, number of employees go up, and the work week lengthen. So there's still a mixed picture out there, even though the headline for Empire Manufacturing, the New York State area, is not great. The underlying details suggest there is, to use Tom's word, resilience.
Right. Well, this is sort of the question as we sort of ask again and again this morning why the long end of the yield curve has experienced such a spike upward. How much of this is actually due to inflationary pressures that might have been underestimated in their stickiness? What are you seeing in terms of the specifics, the amount of savings that consumers still have left over that maybe we'll get a sense of tomorrow?
Well, we keep hearing that consumers have spent down most of their pandemic savings, except for those in the higher income categories who didn't need it to begin with and don't spend everything that they get. So their marginal propensity to consume, as economists say, is not as great. But Americans still seem willing to spend what they earn, and they're still earning at this point a little bit more than inflation. So that's it could keep us going for a while.
You may have noticed that the couple Fed speakers are speaking this week. I know that Tom is very, very concerned about that. I personally kind of enjoy hearing the nuances that they come out with. From your vantage point, what do you think will be most interesting to learn? What is the unknown that they could illuminate at a time of myriad unknowns?
It's something that they won't illuminate. There are 14 speakers this week, 20 speeches, and if you like Pat Harker, he's speaking 5 times this week. But the question out there for everybody is not so much whether they raise rates another quarter point or not, but it's how long is long for keeping rates higher. How far into 2024 do they think they have to go? And I don't think anybody's going to want to say that because they don't know. But obviously the highlight of the week on Thursday, Jay Powell sitting down with our David Weston, and hopefully David will say, we're not letting you go until you tell us.
Let's stop the show right now. How did we get here? I get the idea that when abroad, one of the 12 districts of the Fed, you've got to go out and see the Rotary. You know, you got to go see the Rotary in Fargo or the Rotary here, the Rotary there. But how did we get, Mike, to this frenzy of communication?
Well, each individual bank president wants to communicate in their district, and they get tons of invitations. And I think it's just built on itself. They've spoken to the Rotary in Fargo, so they need to go speak to the Rotary in Williston.
Did we used to pay attention to this when you were covering Arthur Burns?
Well, no. And you didn't see Fed officials speak very much, especially governors. And now you do see all of this Fed speak, which all of the financial news media cover. And so it becomes this big thing. We hadn't had that really before. We were always there for their speeches, but the more we cover it, the more it becomes a central issue for the American people, the more Fed officials feel obligated to explain where they are. Now, Saturday is the great holiday. It's the start of the Fed blackout period.
That's the best news I've heard today.
They're all
Single
trying
best
to get
news.
in before the deadline.
Right.
So,
Michael McKee, thank you for that brief here on economic data. Again, we'll have complete coverage of retail sales tomorrow. Right now, Julia Coronado, president and founder of Macro Policy Perspectives, joins us. Julia, I don't know where to begin between Fed speak and the rest of it. How do you define right now your view of higher for longer?
Well, I think that's where we are in this phase. This is the phase of policy we're in. So we're slowly moving away from do we need to raise rates another time or not, to how long do we need to hold here. And that in and of itself is applying some pressure. I mean, I would attribute some of the last jump in real yields to the realization or the capitulation to higher for longer. And that will in turn take its toll on the U.S. economy. We've seen mortgage applications roll over and builder sentiment sour a bit. So we have another leg of tightening coming through. And I think that's what we've heard from Fed speak, is that they didn't necessarily expect that latest jump in real yields and longer term yields. Now that it's with us and it's staying with us, they're going to want to see how that in turn does their work for them, and sort of be a little patient here, hold their fire at least till December and see how things play out. But the threat of another hike will remain with us as long as we're approaching inflation from so far above their target.
Julia, I'd love your insight on the snark that we portray regularly on the massive Fed speakers and whether it's a good thing or a bad thing that we have such incredible communication. What's your view and kind of how is this sort of framed in your mind?
So ultimately, I think this was a policy choice, right? They had made a decision starting with the Bernanke Fed to pivot towards more transparency. That came with forecasts in the summary of economic projections and the lovely dot plot that I'm sure Tom loves so much, and a lot of Fed speak, forward guidance on rates, et cetera. So all of this transparency, I think, was a reaction to the sense that the American public had no idea what the Fed did. And yet they were incredibly powerful. And I think there was a sense, even before the global financial crisis, but particularly after, that sort of the Fed owes it to the American public to be as transparent as possible. And what that means is what feels like at times a cacophony of voices. But I think that's better than the alternative of the sort of secret temple making all these powerful decisions over our lives.
There's also a question about the ability of the Fed to remain independent politically. And I say this at a time where they will always say they are, and yet the fiscal deficit is getting bigger and bigger. And one of the big instruments to keep yields low has been the balance sheet. There was some discussion last week about the potential for the Fed to deploy the balance sheet or do some kind of yield curve control, as Michael Schowell of Market Field said, if there is this feeling of uncontrollable action at the long end. Do you see that as something that politically they could afford to do?
I think the bar is very high to doing something like that. And based on what we're hearing from Fed officials, they really are quite committed to running that balance sheet down. I think the Fed is uncomfortable with this sort of negative earnings position they're in. And while, they're not panicking, I think they really, really are committed to bringing that balance sheet down. So they have shown a great reluctance to turn to sort of small tweaks to balance sheet policy that they could implement to address concerns about banking liquidity or the yield curve. So far, I think the bar is very high to that.
Julia, I'm absolutely fascinated by their constraints, their lack of degrees of freedom because of a new higher real rate regime. And I guess the nice way to put this is there inflation-adjusted yield policy constraint? Do they simply begin to have less wiggle room?
Oh, I think absolutely they have less wiggle room than they did before. Again, partly because we are approaching their inflation target from above, not below, like last cycle. And so that in and of itself is a constraint that ties their hands. If we have a wobble in the economy, they're going to be a lot slower to turn to policy easing than they were in previous cycles, because they really need to see that the inflation beast has been slain. And I think we've gotten a lot of good inflation news in the last few months, but we're not there yet.
Okay, so Lagarde comes out at the panel I did in Morocco and says, with quite force, we're going to get back to 2%. Amateurs like me read that as 2.0. Does a pro like you read that as 2.9?
No, I think that they can and will get at least a lot closer to 2%. I think we need to be well under 3% before the Fed were to consider, again, pivoting on policy towards actual easing. We think that that's possible, especially if rent finally starts cooling. It didn't in the last CPI, but no, I don't think that they're going to back off quickly. I think we haven't heard anything. In fact, Chair Powell quite decisively has batted down any notion that they would contemplate a higher inflation target decisively and unequivocally. So I don't think that is on the front burner anytime soon.
Julia Coronado, Dr. Coronado, thank you so much. Macro policy perspectives in advance of David Weston's conversation with the chairman of the Federal Reserve. Look for that Thursday. I'm looking at Brent crude 91.24, up 35 cents, 0.4%, but 91 is not $89 a barrel. Equities lift, futures up 20. The VIX comes in 18.58 from a 19 level. What, Lisa, are you looking at?
Well, I'm watching crude, obviously. I'm also just watching the ping pong action that you've seen in the bond market at the long end, the 10-year and the 30-year yields.
That's the right way to put it.
And how much they just have been bouncing. And the new normal, as John was saying, is 10 basis points rather than 3. It makes a big difference. And I do wonder at what point, George Concalves of Deutsche Bank earlier this morning saying that, or Mizuho, excuse me, could say that you basically have corporations that can't really survive in the same kind of way. And that Rite Aid is the tip of the iceberg in terms of normalizing to a 4 to 5% benchmark treasury yield.
Maybe as a mother of all zombies, as the Rite Aid's had a checkered life about it, but it is the great zombie roll-up. And I'm telling you, this real yield at 2.30%, I find to be extraordinary. Futures up 20. The Standard & Poor's futures now up 0.5%.
Right now, we are looking forward to a conversation with Stephen Major, to a discussion that you've been having about price down, that it's not just a yield issue of yield up. And to me, this really is going to be the question. Are we seeing the bond bulls capitulate in a year of incredible bearishness? Without a question, the number one conversation of the day here on bonds, and what I would say, Lisa, that's so important here is Steve Major looks at the microeconomic supply-demand flows that make up the yield curve. He doesn't just partition it into Fibonacci 101. He's really looking at the emotion, and that gets into catharsis here, where you get to a lower yield, price up, lower yield. And trying to understand why we haven't seen it yet. And really, right now, one of the bigger questions is, of everything that we're hearing about in the Middle East, and we have heard guest after guest say that this is a callous market, it is a cold-hearted market, it's a market that looks past the human tragedy and suffering and just, how does this affect me? And right now, people aren't seeing it. But if there is an escalation, that you will see that flight to safety, and that will be expressed in treasuries. And that's what we heard from Peter Scheer. I'm going to take it just simply down to Brent crude here at a 91 level, and you say, well, how does that advance up to something of angst for all world leaders? And the answer is Suez Canal, which is X number of miles from the southern tip of the Gaza Strip. To me, that's maybe the single geopolitical issue that folds into our worlds as well. Well, and what the unknowns, right, at this point, given the flexibility to potentially respond to that, given where we are fiscally, and given the appetite or not to do things. Please stay with us. Without question, our fixed income interview of the day, Stephen Major of Hong Kong and HSBC will join us as well. Futures up 19. This is Bloomberg on radio and on television. Good morning.
The market says there's over a third probability that one of the two meetings is live. I hope it's not. I really hope it's not. But you know that I say that because not only do I worry about the lagged effects and the financial stability and growth effects, but I also do think there's a danger in trying to get to 2% too quickly.
Mohamed El-Arian, Bloomberg opinion columnist, last week with Jonathan Ferro, parsing through how to understand the inflationary environment at a time where the Fed is determined to get back down to 2%. Right now, we can see markets trying to grapple with this as well, as though you are seeing a sort of pinned expectation on the front end of about 5%. And yet the fluctuations continue at the long end, with 10-year yields, Tom, up now just 7 basis points, only a sole 7 basis points after we've seen an incredible amount of volatility over the past few weeks.
I eyeballed the Lisa Abramowicz index, also called the MOVE index, because she moves 10 miles a day on her race back home after the show. And I'm looking at the Merrill Lynch MOVE index, and I guess about all I can say intelligent is we're not to the massive catharsis of 07, 08, 09, excuse me. But boy, we're right there. I mean, on a smooth moving average, I was like, oh, gives pause.
Yeah, this idea of expectation of volatility continuing. Meanwhile, you aren't seeing as much action, ironically, in assets perceived as riskier. I do want to just point to a couple of names that stick out to us. We did talk about Apple earlier and how an independent report highlighted not that much, down about 0.5% off this idea that maybe smartphone sales, the latest edition over in China, are not selling as quickly as they have previously. Stellantis shares, I thought was interesting to point out, down 0.1% after just the sense on Friday. We didn't even talk about this. The strikes are ongoing. They are still ongoing for the auto manufacturers, which I think is important to keep mentioning at a time. We heard from Sean Fain Friday, and he basically said, we can strike at any time. We're at that point in our negotiations.
Well, thank you so much for bringing this up, because there's a lot of other news. We're focused on the president's change in schedule. He was Colorado bound, and he's going to know I'm going to sit at the White House and look at this geopolitical mess that we're in. But there's all these other stories going on. We're committed, folks, to keeping as best we can up to touch with them.
Just real quick, though, to build on the geopolitical story, and I want to end with really the first story, which is Shell shares reaching a new record high.
Yeah.
And this comes on the heels of expectations of oil to increase, but also a renewed focus in this company on oil, not on renewables, not on moving away. And are we going to keep hearing that more and more, especially with the geopolitics?
Really interesting in Morocco to see the IMF not distance themselves, that's too harsh, but to see the IMF move away from that. What's really great about this is our next guest, Lisa, I said to him, what do you think? He says, I'm not coming on again until the tots are in first place. So, it's worked out well.
Well, fantastic. Congratulations. Stephen Major, Global Head of Fixed Income Research at HSBC. And really, I am so glad to speak with you. We're at a time of an incredible bond bear market. Yeah. You've been bullish. How can you reaffirm that at a time where we don't really understand why the sell-off has been so severe?
Yeah, there's been a capitulation. So there'll be people like me, but people with skin in the game, people who are actually long of bonds, who have had to cut the position. That could be for risk management considerations. It could be because clients are taking their money out and they're having to respond to that. So I think there's a capitulation. There's evidence of capitulation in the way the term premium moved. So it's the back end that's where the action is. And I think there's a lot more safety in the front end right now. You can see twos are behaving differently. Maybe for the first time this year, twos have become safe. And I think the mantra has been don't touch the twos all year, because you would have been going against the Fed. If the Fed's done now, more or less, then you're fairly safe entering twos. And that's how the bond market can start to perform better. Money will creep up from the front. That's why people are leaving the back end alone at the moment.
There's a lot there to unpack. Yeah. I just want to go to the whole capitulation story. Yeah. You said there are signs of capitulation. Where? Who is selling so aggressively at a time when a lot of people are saying it's a buyer strike?
Yeah, I think it's probably real money. And there's this game in fixed income about discussing the marginal buyer and seller. The truth is you never know till afterwards. Right? The bond market is fairly sophisticated, but you don't know the buyers until after it happened. You can see the supply coming because it's published, but you don't know who actually bought. There's a lot of gaming of who's going to buy, right? It seems to me the marginal buyer has to be domestic, so it has to be here in the US, because the official sector overseas is not sponsoring the market as it was before. The private sector isn't picking up enough, so it has to be inside here. Now, 70% of treasuries are held in the US. Of course, the Fed's a big part of that, but the story is it has to be here. It's probably not the banks. Real money has already taken long positions and may be adjusting. So it has to go into retail. It has to go to small investors. It has to go to those who are in equities, so big investors on a multi-asset basis. So people coming out of stocks into bonds, people going from cash into bonds. That's where the marginal buyer is.
The great fear here, Steve Major, is what I call the Whalen silence. Chris Whalen, with his wonderful one volume of America Financial History, where in the bond market, you're trying to do something, and all of a sudden on the other end of the phone, whether it's the 18th, 19th, 20th century, there's silence. Are we anywhere near that?
Yeah, well, that's a really good point, because it does seem that there's been a bit of a buyer's strike. And so the evidence for that is in the auctions. So you look at the cover ratios, so how many people showed up to buy the bonds at the auction. There's less there, especially in the long end, the 10 and the 30-year paper. But it gets to the point where the value is just too obvious. You've mentioned real yield several times on the show, but when the real yield is comfortably above the trend GDP rate, the actual trend GDP and the projected trend GDP, then you're pretty covered. So the inflation piece is locked when the real yield is above the trend GDP. You're not going to go too far wrong. Now, I'm not saying that today it's free money. It's just that you'll look back in 6 months' time and you should be happy with the investment you made today.
700 pages at the IMF, the blue book, the green book, the red book. Georgieva says she's going to print a copy just for me so I can read it. The one appendix I read was Tobias Adrian, fiscal instability, liquidity and solvency. Does Steve Major have liquidity and solvency issues as written in his appendix?
Forget the solvency. The US is going to pay its bonds. The idea that you have a ratings issue and that ratings explain the yield shift.
So what about liquidity?
Liquidity, now this is the price of getting stuff done in plain English, right? That's what liquidity is. When the market is illiquid, it's more difficult to get a big trade done. So you have to pay a bigger bid-offer spread. That's my simplistic, plain English explanation. There is a liquidity issue right now because the banks aren't prepared to hold big inventory. The intermediaries are just not there. And liquidity and risk premium tend to move together. So if we have an illiquid market, then the risk premium goes up, and that's your term premium and the higher yield in the long end. That's what's happening right now. I look back at this and I think you've got record moves in the term premium, even back to 2013. And don't forget the context is important here, Tom and Lisa. Back in 2013, the taper tantrum was like the main thing that happened. Now you've had a 2-year bear market going into a 3-year bear market, so rates moved up a lot, then the term premium flipped. You didn't have that back in 2013. So you really are entering a good level of yield at the moment.
Given the fact that you think that we're at a good level of yield, how do you sort of lean into the front end and not the back end, right? Why aren't you just going all in on the 10-year?
Let me be absolutely clear. I think that investors who want to buy bonds for the first time, who are rather shy, can creep into the 2 years out of a money market product, and they're not going to lose a lot of money, if any. You're safe in the 2. So if you're shy and you're going into bonds for the first time, you're safe in 2s. Then you creep up to 3s. Right. Now, for me, if I'm making a call for the next 6 months, of course I buy 10s or 30s, because I'm going to look back in 6 months' time and think that the yield's fallen 100 basis points.
Where is it going, though, at the end of the year?
Well, our forecast is 3.5. We're running out of weeks and months, of course. Right. But 3.5 could be the right number in 6 months' time. So I don't think we've got the directional call wrong here. I think yields will be lower. It's just that maybe our timing could be off.
Yeah, it's the same as like guessing if West Ham's going to do well or not. We're running out of time. Steve Major, one final question to real. Joyce Chang, J.P. Morgan, on stage in Morocco, said she's modeling out a 2.5% inflation-adjusted yield. That took me back. That seeming was elevated. Take your nominal lower yield call and squeeze it into a real rate call.
Yeah, so the 2% inflation is locked. If there's one thing that's come through all of this is that inflation targeting is credible. The 2% inflation has not been challenged in the break-even forwards. So for me, it's all about real yield. 2.5 is just way above trend. Therefore, we can take 100 basis points off of that. I think that a fairer level for the real yield would be 1.5, not the 2.5 that we're trading at the moment. And by the way, that would still be above 100 over the Fed's R-star measures. So you people are saying that the real rate needs to be higher. Well, it's priced as a lot higher.
We got to go. Stephen Major joining us with the Hong Kong Shanghai Banking Corporation. Tonight, please stay tuned to all of our reporting from Washington. Balance of Power with Representative Stevens of Michigan.